New York City, I'm Brad Smith alongside Akiko Fujita this morning. This is Yahoo Finance's flagship show, The Morning Brief.
We've got a lot of ground to cover. Fed fodder fueling gains this morning. You can see futures climbing as investors digest the Federal Reserve's latest interest rate decision. The FOMC holding rates steady as Fed Chair Jay Powell reiterates more progress on inflation is needed before embarking on a rate-cutting cycle.
That's right. And another test to the market's strength, corporate earnings. Tech investors eagerly await Apple's second quarter earnings after the markets close today. Wall Street bracing for a sizable drop in iPhone sales out of China. Plus, what will the company say about the pace of its investments towards generative AI? So let's get to it with the three things that you need to know, your roadmap for the trading day. Yahoo Finance's Jared Blickery, Dan Halley, and Madison Mills have more.
Stock futures climbing higher after the Federal Open Market Committee voted unanimously to hold rates steady. We heard a notable shift in Fed Chair Jay Powell's tone on Wednesday. Interest rates are going to stay higher for longer than expected. Powell emphasizing that more progress on inflation is needed before rate embarking on a rate-cutting cycle.
We didn't see progress in the first quarter, and I've said that it appears then that it's going to take longer for us to reach that point of conference.
Powell's comments mark a clear shift in the Fed's outlook following a fourth straight month of hotter inflation readings.
Plus, Nasdaq 100 futures are leading gains ahead of Apple's earnings. The tech titans' results will be the next test for markets as Wall Street races for an iPhone slump in China, one of Apple's most important sales regions. Investors will also listen closely for any insights from CEO Tim Cook on the company's AI efforts.
And a C-suite shakeup could be just what Peloton needed. Shares jumping after the home fitness brand announced CEO Barry McCarthy is stepping down from his position. Peloton is also cutting 15% of its global headcount, all in an effort to cut back on costs. This comes as the company continues to struggle over its post-pandemic slump.
Well, good morning, everyone. Let's take a look at the market action. We've got 30 minutes before the opening bell on Wall Street. Before that opening cross-stock futures, right now, we're taking a look at the Dow, the Nasdaq 100, and the S&P 500 futures, all in the green. The Fed's decision to keep interest rates unchanged, largely expected. Fed Chair Jay Powell reiterating more progress on inflation is needed before embarking on a rate-cutting cycle. Investors now tracking a slew of corporate earnings and looking ahead to Friday's jobs report as well here, Akiko.
Yeah, we are taking a look at Treasury yields as well on the back of that Fed decision that came down yesterday. Really, it was the Fed Chair's comments that moved the market, and we saw the yields pull back initially on the back end of the Fed Chair, saying that a rate hike is unlikely, at least in the next policy step. Today, we are seeing, at least before the market opened here, yields pushing a little higher. The 10-year yield right now at 4.61%. Brad, it's interesting going back to what you were saying about earnings back in focus now that we got the Fed decision out of the way. Apple's certainly going to be one that we've been watching very closely. We saw it up, at least in pre-market trade here. China going to be a big focus, AI another one as well. And Apple stock hasn't necessarily done really great, at least in the first half of the year. Yeah,
you're seeing Apple in that far corner right now, higher by about 1.6%. If you go ahead and hit Apple, we can give folks a view of just exactly how far year to date we've been able to come here. And actually, we can plop that on and layer it on right now. It's down by about 12% year to date. Compare that to some of the other mega cap tech stocks right now that have all talked about the pace of their generative AI investments over the course of this earnings season.
Yeah, we're going to get a lot more into those numbers a little later in the show. But first here, Fed Chair Jerome Powell reiterating during his press conference yesterday that it will take longer than expected to reach the 2% inflation goal.
We didn't see progress in the first quarter, and I've said that it appears then that it's going to take longer for us to reach that point of conference. So I don't know how long it'll take. I think it's unlikely that the next policy rate move will be a hike. I'd say it's unlikely.
Well, our next guest says rate cuts are still a matter of when, not if. Gabriela Santos, who is the JP Morgan Asset Management Chief Global Strategist for the Americas, joins us now. Great to see you, and thanks for joining us here in studio this morning. I mean, as we're setting up today's trading activity, of course, a lot of minds still going to be lingering on what the Fed had to say yesterday. I wonder what your initial reaction was, especially when it was largely anticipated.
I think versus the last meeting, the March meeting, certainly there was more of a hawkish tone, a realization that inflation wasn't coming down as quickly as expected. But versus how hawkish the market had gotten during the month of April, I think it was actually a bit of a relief. Ultimately, it's still the same message from the December meeting, which is we're done hiking, we're going to stay at high, not higher, for longer. And our next move is going to be a cut and a very gradual cut. So ultimately, I think it was a relief just to hear that hikes really aren't on the table, and they had actually been priced in before the meeting yesterday.
Yeah, in many ways, this was a Fed chair trying to keep optionality open. He's kind of been doing that, at least in the press conferences here, saying that there's not going to be a rate hike, at least on the table right now, but saying that potentially, when you think about what could actually move that rate cut sooner. I mean, what is this? Is he trying to change the message here to set the expectation, at least for the market, to essentially say, look, this is where we are right now, but it's going to take some time?
Yes, and I think he really marked to market his message. The market had already adjusted quite hawkishly expectations from 7 cuts in January to barely 1 cut for the year. So I don't think he was trying to jawbone the market, really just to validate that expectation and to talk down the expectation of a hike. In terms of what it'll take, still very much on the inflation side, I think, as a priority, taking a look at actual inflation data. He seems to think 3 months is a trend. So whether we start seeing a little bit more disinflation over the next 3 inflation prints. He also mentioned inflation expectations as being very important. Consumer measures, business measures, and market measures of expectations. And then lastly, the other path he talked about is a substantial weakening in the economy and specifically the labor market. But really the focus is more on the inflation side for now, I think.
And so if we get a hotter than expected print at this week's monthly employment situation reading that we're going to get tomorrow, Friday, what does that signal for the Fed's road ahead here?
So I think Chair Powell mentioned how they see the labor market, which is one that's resilient, that's strong, but that's normalizing. And ultimately, that's what we heard from the JOLTS report earlier in the week, and what we think we'll hear tomorrow in the jobs report, meaning we're still creating, on average, 270,000 jobs a month, which is great. But you don't see that red hot jobs market that you had, which was really 2 years ago. And a way to see that is in wage growth, which we expect to increase, which has been the trend, 0.3% month over month, a little bit over 4%. And that's a labor market that's good, but not too good. So it really supports this soft landing narrative, which is our base case, as well as a high but not higher for longer message from the Fed.
Yeah, on that point, has anything changed for you in terms of your investment thesis based on what we heard yesterday?
And no, and I think that's where investors need to be really careful not to get whiplash from this narrative ping pong that seems to be the case daily. I mean, 2 days ago, we were talking about stagflation when there was clearly no sign of this at all. When you look at, for example, the misery index, a combination of unemployment rate and inflation, it's actually the lowest it's been 70% of the time since the 60s. So we got to be careful, take a look at the totality of the data. And still what it suggests is the same message from earlier this year, that this is a non-inflationary good economy, and that is quite supportive for risk assets, equities, corporate credit. It's just the valuations. It's much harder to eke out value, and that's where you have to really take an active approach.
Gabriela Santos, who is the JP Morgan Asset Management Chief Global Strategist for the Americas. Thanks so much for taking the time here with us.
Thank you.
Absolutely. And everyone, we're tracking Apple here this morning as well. Apple reporting its fiscal second quarter earnings after the closing bell. That's coming later today. The stock down over 12% year to date. Much of that because of the slowdown in China sales and a lag on AI development relative to some of its big tech peers. For more on what traders need to watch for in today's earnings report, we've got Yahoo Finance's Tech DH, the Dan Halley that you all know and love. He's here with us in studio. Hey, Dan.
My dad just really hated that swing that I did. Little League didn't do much for me.
Elbow out.
Yeah, elbow out. I think the big thing that traders are going to be looking at, obviously, is going to be China. The headlines have been that sales there are going to be far lower than anybody may have expected, even a few months back. And there's two reasons for that. There's obviously China's economy, a little slow there, and then the resurgence of Huawei. And it's an interesting discussion, right? Because when the U.S. effectively tried to kneecap Huawei in 2019, Apple came in and took a lot of that market share from where Huawei was. And now that Huawei has returned, that market share is kind of returning back to them. And so there's this kind of equilibrium kind of setting in, and it doesn't look good on paper, obviously. The other thing that people should be looking out for is services. This is supposed to be one of the lone bright spots in Apple's earnings report. They're expected to be up around 10, 11% year over year. That's compared to declines in Mac, iPad, wearables, iPhone. That's what the projections are looking like now. So services is a good indicator of Apple holding on to consumers. That's also part of the problem when it comes to iPhone sales, as well as regular device sales, things like the watch and AirPods. If you have something and it works a long time, why are you going to go out and get the next one when they're effectively more or less the same? And then finally, there's AI. And that's going to be a discussion that we could hear more from Tim Cook or Apple's CFO, Lucas Mairati, basically going over how much they're spending, perhaps going into more about what we can expect at WWDC. Don't forget, Apple's also hosting its own event next week, May 7th, where they're expected to go over some iPad news. Perhaps we'll get some insights into what the AI section is doing for Apple, but that's going to be a main push moving forward. A lot of analysts are looking at that as being a potential catalyst for iPhone sales, potentially for iPad and Mac as well. They're going to most likely include this technology across their various OSs. So they'll have to come up with something that really gets consumers, enterprises interested in generative AI for the smartphone. Right now, ChatGPT is cool, it's good for the enterprise, but for consumers, it's not really doing too much quite yet.
All right, Dan, we're going to be watching for all these themes and much more. Yahoo Finance's own Dan Howley. Thanks so much. Appreciate it. We're also watching shares of Novo Nordisk this morning, the most valuable company in Europe, moving to the downside despite beating the street's profit expectations for the first quarter and more than doubling its sales of its blockbuster weight loss drug, Wegovy. For more on the pharma company's Q1 earnings, we've got Lars Jorgensen, who is the Novo Nordisk CEO and president, alongside Yahoo Finance senior health reporter Anjali Kamlani. Anj, take it away.
Thanks, Brad. Hi, Lars. Welcome back to the show. Thank you so much for joining us today. Really a good quarter, and obviously the drugs, Ozempic and Wegovy, really leading the beat that you had on those numbers. But we did also see the miss on Wegovy sales. I know that the price has been lowered, and you've been ramping up manufacturing. Talk to me about all of that and how this is impacting the company.
Yeah, good morning. Thanks for having me. We're quite encouraged about the Wegovy momentum in the US. It's right that we came a bit short compared to consensus. Now, I don't calculate consensus, but what I can see is that we ended fourth quarter with some 5,000-6,000 weekly new scripts, and we are now at around 27,000 new scripts on a weekly basis for people starting treatment on Wegovy. So we guided that we would be increasing the starter doses, and that's exactly what is happening. And we see that turns into a very nice uptake in scripts, and that's very encouraging for the coming quarters. And it's really a proof that we're gradually ramping up manufacturing and bringing that to patients in the U.S. market.
And you highlighted the lower price of Wegovy that we're now seeing. What is driving that price decrease? And also, will manufacturing impact that in the future, or was this a one-time reduction to sort of meet competitors?
Yeah, you have to be careful about judging pricing on just a single quarter. What we typically see in the U.S. marketplace is that you give rebate enhancements year over year. And obviously, there's also a competitive product now in the market. So we see a slight erosion in pricing. That's not much different compared to what we have seen on other medicines. So it's really about the significant volume opportunity that we are ramping manufacturing. We are getting more scripts, and we're helping many more patients deal with their obesity. And I think that's intact, very exciting growth story.
You also had other good news this quarter with the expansion label for Wegovy for cardiovascular benefit. Have you seen that increase in coverage from insurers, from Medicare? What are you hearing?
Yeah, that's truly exciting, and it proves that when you use semaglutide, our molecule, it's actually resulting in more than weight loss. And the label we have agreed with the agency also talks to that there's a unique mechanism here. And you can say a tangible sign is that we are now actually selling into, say, the CMS part of business where obesity medicine has not been available in the past. But the fact that there is this cardioprotective profile of our medicine, Wegovy, means that we are now actually also in the government channels. So that is already paying off and expanding the market opportunity for us.
Speaking of the government, I know there's many different avenues in which the government has its eye on Novo. First, you've got the investigation by Senator Bernie Sanders. We've also heard potential for Ozempic to enter Medicare negotiations as part of the IRA sometime later in the decade, as well as the FTC's warning letter about the junk patents for Ozempic and other drugs under Novo. What can you tell us about all this and how you're handling these? And is it really posing as strong headwinds for the company?
Well, maybe address them one by one. I don't really like the terminology junk patents because I think we have very good patents and we are ethical in how we patent our products. The particular FTC questioning is in relation to whether our device patents should be on the so-called Orange Book listing with the agency. We have tried to follow what we believed was what the requirement in terms of listing the patents covering the products we have on the market. So it's important for me to underline this is not linked to the compound patent, the basic molecule, and honestly, we can live without the patent on devices being listed on the Orange Book. There's nobody doubting whether the patents are true or not. In terms of pricing, I'd also like to use this opportunity to tell that when you look at a product like Ozempic, our type 2 diabetes medicine launched in 2018, year over year we have realized a lower price, and we are actually realizing a price today that's some 40% lower than when we launched the product. So there's a lot of talk about list pricing in the US, but really what companies compete on is the price after rebates, fees, discounts, whatever. And there we are actually giving the product at a price point that's 40% lower than when we launched. There's a lot of complexities, I acknowledge that. So I think it's important to get into the details of these to get a true and fact-based discussion around price development in the US market.
Fair enough. Looking at, you also have Denmark that has started to block access or restrict access starting in November. What does that tell you about sort of the focus on pricing of this drug right now?
Well, I think it illustrates that each and every country is different in how they manage medicines and how what are the requirements for having been on, say, other medicines before you start, the latest innovation. And in Denmark, there is a wish to have patients testing out some of the, less efficacious medicines before you go on the high efficacious medicine, and we respect that. There are other countries having similar requirements. For us, it's important to underline that type 2 diabetes, obesity is typically progressive diseases where patients over time need to have more and more efficacious medicine. And that's where we come in with products that are highly efficacious and actually now also proving to prevent kidney disease, cardiovascular disease, and we're also testing out a number of other indications. I think that adds to the totality of the value on being on these medicines. And in the meantime, we scale up manufacturing to get to more and more patients. And I think that's something we are quite pleased with.
Absolutely, yeah. We're going to have to watch that manufacturing. You're increasing the demand so much. And finally, as Brad mentioned at the start, you are looking at your shares down right now. What do you think investors are looking for the Novo Nordisk story?
I think it's really one about coming out a bit short on consensus estimate for Wegovy. Wegovy obviously being a key driver, but I think it's really about when did we get the starter doses ramped up during the beginning of the year, and we have done that now, and we see that a number of scripts are really ticking up. So I'm quite confident that our growth outlook for the year, which is very robust, I would say, that is intact, and we are very comfortable in what our innovation does, our ability to ramp and get to many more patients. and thereby also deliver the broad health benefits that comes from treating both type 2 diabetes and obesity.
Well, certainly no small feat to be quintupling your prescriptions in just a few short months and the sales that go with it. We'll have to leave it there for now. Lars Jørgensen, Novo Nordisk CEO, thank you so much for joining us.
Yeah, incredible to see that growth there. Thanks so much for that, Anjali. Well, Peloton shares are in the green. This after CEO Barry McCarthy resigns, and the company is set to cut about 15% of its global workforce. The board will search for a CEO, but in the meantime, the board chair and director will serve as interim CEOs or co-CEOs. The C-suite shakeup overshadowing Peloton's fiscal third quarter earnings today, reporting a wider than expected revenue and earnings per share loss. And Brad, when you think about Barry McCarthy, I mean, he's been in this position for just 2 years. He was the guy that was brought in to really clean house, try to turn things around. He went through aggressive cost-cutting measures, moving more towards a focus on subscription, less reliance on equipment. And yet here we are 2 years later. The needle has moved, but maybe not enough.
Okay, so notable under Barry McCarthy. Cut a lot of positions, had some partnerships on the retail front, and then getting them into some of the hotel experiences. So the retail side, Dick's Sporting Goods, Amazon, great. But then on the other side of that, you think about, all right, what has materially changed? And in fact, they've actually leaned more into the resale market for this business, which directly impacts something like your products revenue, which is connected to fitness, connected fitness products revenue that's continued to decline. This most recent year-over-year decline for the quarter, down 14%. And then you look at where they're going to ultimately have to continue to track some of the ending paid connected fitness subscriptions right now. That was flat year over year here too. And at the same time where the company has ended new free signups for their free app, new signups for their free app as well. So all these things considered, it's a larger question of how do you continue to monetize those people who are within that subscription revenue pie, but at the same time show them a product, a service at the end of the day that they're going to want to continue to spend higher into as well.
Well, when you think about the messaging coming from the company too, it doesn't seem like a real change in direction, at least for now. Obviously, they have to find the next CEO, but you do wonder if this is kind of the base for the company.
If this is trough.
Exactly.
Yeah.
I mean, when you think about just the highs that it went through and then sort of been coming down, to your point, yes, they need to find additional revenue, but you got to wonder if this is kind of just where things are likely to be for the company for a while.
Absolutely. All right, everyone, we're just getting started here on the Morning Brief. Guess what? Coming up, Qualcomm, they beat estimates in the latest quarter. AI demand boosting sales in China. We're going to break down the results on the other side of the break. And then later on, guess what? We're going to be joined by the CFO in our brand new show, Catalysts. That's at 10:30 a.m. Eastern, that conversation. You don't want to miss that. We'll be right back. Grab a snack. Come right back.
Shifting to the chip space, Qualcomm shares climbing higher today after giving an upbeat outlook for sales and profit in the current quarter and signaled a rebound in its smartphone segment, particularly in China. The chipmaker's phone sales surging 40% in the first half of the year in that market. And obviously we talk about China, Brad, because Qualcomm is the most exposed when it comes to that market. I thought it was interesting, some of the commentary that came through, at least on the earnings call, talking specifically about the rebound that we're seeing in China. Yeah. If you take out Huawei, every one of those Chinese smartphone makers does have Qualcomm integrated. And so what they said specifically is even with the re-entry of Huawei, that's pushing consumers towards the higher end market. And that's a big revenue driver for the company.
Yeah, particularly interesting some of the commentary we're getting out from the street as well here this morning. JP Morgan putting in the very top line of their note, robust smartphone, rampant auto, Internet of Things, IoT, help Qualcomm budge normal seasonality and peers. They raised their price target, by the way, to $185 here, and essentially saying that the second quarter, the fiscal second quarter, was largely in line with expectations, revenues tracking towards the midpoint of the company's prior guidance here.
14 analysts in all raising their price target, so that points to exactly the kind of results they saw on Qualcomm. The automotive business is a really interesting one for me to watch. I mean, this is one that Qualcomm has been pushing for some time. They saw some huge growth on that front as well. $603 million in revenue, a big beat in that area.
Absolutely. Well, stay tuned for Catalyst. We're going to be speaking with the CFO of Qualcomm. You do not want to miss that. Akash Palkhiwala. There you see him on the screen. You'll see him later on the screen, about 10:20 a.m. Eastern time for that conversation. Well, it's time for some trending tickers here on the day. DoorDash shares sinking this morning after its profit outlook for the current quarter fell well below expectations amid rising costs. Yahoo Finance's Brooke DePalma, big time ordering energy. You don't do delivery, huh?
I don't tend to do delivery that much. I guess call me non-Gen Z, non-millennial, but I tend to either cook at home or go and walk and pick it up. But definitely not contributing to this quarter. That was a matter of fact. But we are seeing Wall Street weigh in on here is that adjusted EBITDA outlook for Q2, the current quarter that DoorDash is in. The company now expects that adjusted EBITDA to come in between $325 million to $425 million. That was on the lower range of what Wall Street was hoping for, $394.4 million. Now, the company did say on the call that in the first half of the year, they continue to make investments in restaurant, grocery, and new verticals. We know that DoorDash has been investing in retailers like makeup and sportswear and even home improvement retailers, Lowe's. The company also has been improving efficiencies like speed of service. They said that will then lead to increasing EBITDA in the second half of this fiscal year. And the CFO saying on the call that they expect the full year to be pretty strong. But expectations were really high for this quarter from Wall Street. Over the past year, the stock is up more than 90%. Year to date, shares are up more than 28%. Deutsche Bank out with an interesting note this morning saying, quote, don't overthink it, buy the dip, buy, whereas Roth, MKM coming in with a note that titled Premium Valuation plus Yellow Flags equals no mercy, no malice, staying neutral. So a bit of a mixed response here from Wall Street, but we did see consistent trends in the quarter. Total orders are up 21% to 620 million orders. So of course, lots of competition brewing in this space.
Do we have a clear picture on how that breaks down? I mean, I think about when I order on DoorDash, there's always those add-ons that come on board, right? Groceries, a big one that they have been pushing in that direction as well. What kind of gains have they made there?
Yeah, well, definitely grocery is something that they've been doubling down on. And I think that when they add these new retailers, like, say, a Lowe's, like, say, a makeup retailer, really speaks volumes to the consumer where they're at right now and the fact that they do want convenience. They want to be able to get whatever they need at the
Pointing at me while you say that? Like, oh, my gosh. Just outing me?
But they want that convenience factor, and groceries have come at a higher cost lately. So if customers are paying a higher cost, they're saying, hey, I'll take the convenience as well.
The key is to not look at the rates at the bottom.
No, I don't.
Just look at the total from the restaurant and then just press.
Yes.
Because if you start like, I just can't, I used to order a lot.
I still do. I have to limit it. I've had to cut down. I mean, I'm hosting the show Wealth now. I got to, follow what I preach a little bit here. Got to figure out where those savings are. Brooke, thanks so much. Appreciate it. We're just seconds away from the opening bell here this morning. Let's take a look at the bell ringers. Oh, my gosh. Make a wish. Oh, this is just heartwarming. This is the wish. We're watching it. All right, make a wish, ringing the opening bell at the NYSE. Is nobody else excited? It's exciting. All right, anyway, at the Nasdaq, you're also seeing an opening bell ringer there. Man, that's heartwarming, touching. Let's take a look at the markets here. Market Check sponsored by Tasty Trade here this morning. The Dow Jones Industrial Average opens higher by about 0.6%. S&P 500 also opens higher fractionally by about 0.7% there. Our Nasdaq is calibrating right now, but we were seeing the futures point higher as well, and there we've got it. The first print higher here on the day by about 150-ish points, nearly 1% to the upside out of the gate here this morning. Also, let's talk a little Carvana shares. They're skyrocketing this morning after giving record first quarter results. The used car retailer reporting net income of $49 million. That's a big jump from the $286 million loss that it posted in the same period a year ago here. Now, of course, oh my goodness, this outsized move to the upside, 38% in a jump here this morning. Of course, one of the huge things is really just where the car market stands right now, especially with some of the financing that consumers have to consider when making a purchase such as this.
Well, you have to wonder how much more upside there is, as in there's more upside given where the rates are right now. But can we just talk about the stock move itself? I mean, it's 64% higher year to date.
Yeah.
But I wonder if we can show this chart because it has just been a very choppy trade. So you have to wonder. I mean, I've always been a little bearish when it comes to Carvana, but it was at such a bottom that you have to wonder that the upside, at least if you're an investor in the stock, I mean, you gotta love it. It shows 37% higher today.
I mean, just 2 years ago, this was the worst company of the year, the biggest loser of the year for Yahoo Finance ultimately. And one of the huge things that goes into that consideration is really just the ultimate demand cycle that this company has to continue to wade through. And, the operations for this company of how they go out, purchase cars, and then look to resell them as well. I mean, building out car vending machines is one thing, but then going out and spending a lot of money on getting those vehicles to bring them onto your lot. At a time where consumers are trying to figure out, all right, for one period of time, about a year and a half ago, are we actually in a better position if we just go out and purchase a new car because we get the warranty, we would get the factory service warranty on top of that versus what we would get by purchasing via Carvana or one of the other used vehicle. And then additionally, you've got Enterprise, you've got some of the rental services that are offloading some of their fleets too. Yeah. So that's direct competition as well.
Well, the company, to that point, on that business model, saying that this result validates our long-held belief Carvana's online retail model can drive industry-leading profitability. Good day, at least.
Good day today.
Today. We've got a jam-packed morning for you on our show, Catalyst, in the 10 o'clock hour. We're going to speak to Moderna CEO Stefan Bancel on the future of the company amid diminishing COVID vaccine demand, and Qualcomm CFO on what it stands to benefit in the AI-powered smartphone space. Then in Wealth, we're going to speak to Kellanova CEO Steve Cahillane, I hope I got that right, on why snack foods might not save your budget while inflation is high. Stick with us. That's all coming up. We are continuing coverage of the opening bell on Wall Street. Yahoo Finance's Jared Blickery standing by to take a look at the crypto space. How's it moving, Jared?
A little bit of green behind me. Good news for Bitcoin enthusiasts. Let me just point out what's happened over the last couple days. Yesterday, we had that FOMC meeting and stocks rallied during the presser and then they sold off right afterwards. Guess what Bitcoin did? Pretty much the same thing here. Came right back down to where it started, and you're seeing 57,000 is a low over the last 2 days. And now I want to show you a year-to-date chart. 60,000 has been a support for several months now, and it was just broken to the downside. So this is something Bitcoin does quite a bit. If it were to pop back above 60,000, might see a rally from here. That would be ideal for the bulls. Or we could simply use 60,000 as resistance and head down again to maybe 45,000. We'll have to see what comes of that. But I also want to point out what's going on in the ETF space, because yesterday we finally got a huge day of outflows from those spot Bitcoin ETFs. IBIT in particular suffered its first day of losses. That was about $35–40 billion. Fidelity's offering FBTC here, that lost about $200 billion. Overall, it was about $550 billion of outflows in the spot Bitcoin ETF space. Just notable because that has been the reverse of what we've seen so far. A lot of interest in those spot Bitcoin ETFs. So far, it's been sell the news, but I go back to the main point here, which is that if Bitcoin in particular is able to rally back above 60,000, well, then we got those 70,000 highs and beyond in sights.
All right, Jared Blickery, thanks so much. Jared, appreciate that update.
Well, yields are slipping past 5% after Fed Chair Jerome Powell re-emphasized the need to see more data before they have the confidence to cut rates.
The economic outlook is uncertain, however, and we remain highly attentive to inflation risks. And I think it's appropriate to take signal now, and we are taking signal. And the signal that we're taking is that it's likely to take longer for us to gain confidence that we are on a sustainable path.
Our next guest thinks while we stay higher for longer, there might be some opportunity in the fixed income space. To break it all down for us, Leslie Falconio, UBS Global Wealth Management Head of Taxable Fixed Income Strategy, is here. Leslie, good to talk to you today. We saw the markets push higher in a significant way yesterday on the back of those comments from the Fed chair. The yield's pushing higher today, but I wonder if anything has changed for you, at least in your outlook, given the messaging coming through from the central bank.
You know, it hasn't. And I think the important point is that the market was very hawkish going into the Fed meeting. I mean, they had priced out a tremendous amount of cuts down to about one cut at the end of the year, 30 basis points. But it wasn't just about 2024. They also had a very shallow cutting path into 25 and 26. And this left that terminal rate or that neutral rate well above 4%, which we deemed, and we still deem, a bit too high. And I think that because the rumor of this potential hike was so permeating the marketplace, and they asked Chair Powell 5 different times about whether or not that would be the path. And I think he actually sort of eliminated that, probability. You can never say never, but highly unlikely. But he also, acknowledged that inflation is not making the progress that they had hoped, and they are going to still be data dependent. And more than likely that high for longer might last a little bit longer, but he clarified the path of cutting. And I think that's really the important part here.
Leslie, do you believe that the Fed is going to be able to declare victory on inflation, and will that come at some point this year?
Going to the 2% target, and I don't even think they have that in their own projections when you look at the S&P. I think they need to see, continued progress lower, right? They want to see this disinflation trend, and they just don't want to see an acceleration, right? It doesn't have to be at 2% before they cut, nor do we think that it's going to be at 2% for quite some time. But I do think they just need to see and move in the right direction. So I think that in terms of that commentary, he made that perfectly clear. He also emphasized how far they've come. How far they've come in, labor loosening, how far they've come with inflation coming down versus these pre-pandemic levels. This first quarter data has just been a bit disappointing. And he also mentioned the nuances that we have with owner's equivalent rent and auto insurance and those things that have really kept inflation elevated. But I do think that when we do believe that inflation trends down in the second half of the year, we think growth will also trend down in the second half of the year while remaining above trend. That's why we lean more towards that soft landing camp. But he just can't see a reacceleration. And I think that is what will really change his tone, reacceleration for a sustained period of time.
Leslie, one of the things the Fed chair wasn't asked about yesterday is about the external factors, things that are not necessarily in the Fed's control. You look at what's happening overseas, maybe potential developments in Ukraine. We saw how it played out, at least in the energy market, in the initial months of the conflict there. I mean, how are you thinking about that? We sort of talk about it as if this is about the Fed policy taking hold and really trickling down, but there are a few things here that could be X factors, keep inflation sticky.
Well, I mean, I think that's a great point because there's a lot of things that haven't been in the Fed's control, right? Hiking interest rates is not going to alleviate supply issues, right? So, or when it comes to the say geopolitical risk, the risk there, say if oil spikes, it has, he's mentioned this, and we believe this as well. It has to be for a sustained period of time. So if it's something that occurs over 3 to 6 month period, I don't think that changes the outlook. But I think one of the things that he is a bit surprised as are we to a certain extent, that he still calls the current policy rate restrictive. But we know that these higher interest rates hasn't had really that impact on the consumer as one might anticipate, except for, say, the mortgage rate or the residential housing market. But as we know, most of these consumers locked in at 3.5%, 4%. So I think that having control is taking a little bit longer than what he thought. And I think the fact that they've been on hold for 10 months at a peak rate of 5.25%, 5.5% hasn't had the impact in terms of curtailing demand to the extent to which I think he thought it would. And we feel the same way. But we do expect demand slowly to decline. We do expect the labor market to start to loosen over time. But I do believe that he's in a situation where inflation probably won't drop as quickly as he would like. And if he keeps rates higher for longer, and this headwind to demand starts to accelerate, you could see that unemployment rate go above 4%. And I think through his eyes, that's when the problem could occur, and that's when they're really going to start cutting.
Leslie Falconio, who is the UBS Global Wealth Management Head of Taxable Fixed Income Strategy. Leslie, thanks so much for joining us here this morning.
Thank you.
Certainly. Coming up, everyone, sticky inflation could pose a big problem for President Biden heading into the election. What are the key concerns for voters, and is it Trump or Biden who wins for lowering prices at the pump? We'll discuss that next. The presidential election just around the corner, and inflation remains top of mind for voters. So what does this mean for President Biden's re-election campaign and perhaps reflection on the vast couple years? Yeah, Yahoo Finance's Rick Newman joins us now. Yeah, right around the corner if you have a warp speed button, I guess, at this juncture.
Yeah, well, it's coming fast, yeah. So, you know, a lot of in polls, there's this interesting finding that Americans think back on the Trump term as a good time for the U.S. economy, and I guess they sort of put COVID out of the picture because that dominated Trump's last year. But they do think that things were better off overall during Trump's presidency, and one of the big factors is gasoline prices. So I just wanted to bring the data together, and in fact, gasoline prices were cheaper under Trump than they've been under Biden, and that's true whether you just look at the nominal price or you adjust for inflation. But they were also lower during the second Obama term, and that was a trend that just continued into Trump. And I think that if anybody thinks that if Donald Trump gets elected president, then somehow gas prices are just going to go down because he has some magic button he can twist, that is not going to happen, because this whole market is totally different now. And what was happening during the Trump presidency from 2017 to 2021, we were, the fracking revolution in the United States was picking up steam. We actually had massive overproduction of oil in the United States. And the way you know that is the energy sector performed absolutely terribly during that time. And the reason was they were treating fracking as if it were a growth industry. In other words, you think of startups that go for growth over profitability, try to grab market share. There were lots of energy companies that were trying to do that. And this industry completely face-planted in 2020. Remember, oil price, there was so much overproduction that oil prices briefly went negative. So that is not going to happen again. Whether Trump becomes the next president or Biden remains president, it is not going to change the market for oil and gasoline.
Well, and the important reminder being here that we're talking about the U.S. market, but
right.
Gas, oil is a global market, right? I mean, this is kind of the dilemma that anybody who occupies the White House faces because they are blamed for anything that's bad in the economy as well as oil. The reality is they don't control as much of it as we'd like to think.
The president actually has almost no control over oil and gasoline prices.
So here's my question to you, though. Are there any levers that the president can pull right now, a la SPR, that can at least publicly give him a win?
So the propaganda on this is quite different from the reality. And of course, Trump says his mantra is drill, baby, drill, get rid of all these stupid electric vehicles. But look, we have record oil and gas production, and I mean natural gas production right now under Biden, the supposedly, the green energy president who's supposedly hostile to big oil. And that is because of the market. Market prices are high enough that American drillers want to drill. They are protecting their profits much more aggressively than they were prior to 2000. But prices are high. And, another thing that has happened is that we had a war between the OPEC plus nations led by Saudi Arabia and American frac. People don't even know this. America is now the biggest oil producer in the world. I mean, you guys know this, but a lot of people don't. We have been started during the Obama administration again. So these are long-term trends. We had OPEC and American frackers trying to outproduce each other in a big market share battle 2018, 2019, and that's why prices were low. So now we have OPEC Plus cutting back on production because they want to push prices up. If Trump becomes president, OPEC Plus is not going to say, oh, now we're going to open the gushers because we don't care if prices go down. They're going to keep production tight. So I think there's every reason to think that gas prices now around $3.60, $3.70, that is a normal market price, and it doesn't matter who the president is.
And typically, in the summer months, right before Memorial Day, we start to see
a little bit, yeah. There's a shift over. I mean, that involves the refineries in the United States, but then things settle down over the summer as that transition is in effect, and then prices, we're talking about 10, 15 cents.
Yeah, the White House is watching closely to see when does it start to come down. Is it in time for the election?
Are they ever? And they even floated the idea that maybe they'll release some new oil from the strategic, some additional oil, and anybody in the industry was like, that is a terrible idea. Yeah. I mean, gas isn't even at $4 per gallon. We don't have an emergency. You could argue even $5 it could be a political emergency, but not an economic emergency. Yeah. So no one thinks we're going to get much over $4. Gasoline prices probably will stay in the mid threes, barring something unforeseen, some kind of disruption in the Middle East or something like that.
Yeah, all that points to just how challenging the messaging is for both candidates. Rick Newman, as always, thanks so much.
Thanks, guys.
Thanks.
Well, NIO shares are climbing higher after reporting its deliveries in April, jumped over 134% from a year ago. This brings its total to more than 45,000 vehicles delivered so far in 2024, a 21.2% rise from last year. And Brad, it's not just NIO. And obviously, that share stock there getting a big bump overnight in Hong Kong trade. Now they're getting up about 2% here. But all the car makers here in China posting deliveries that were higher.
Yeah.
At a time when we're talking about just how competitive the market is, price cutting certainly contributing to that as well. But you have to wonder where all this is going to go when you just think about just how saturated the market is right now.
Yeah, and it's really a big question of, okay, for as much as Tesla has really initiated much of that price war, where they're beneficiaries in some of the homegrown automobile manufacturers, especially within the Asia Pacific region. And so as we've seen some of the consumer sentiment shift there, Tesla has unfortunately seen the short end of the stick on that one. And then now you've got BYD, you've got NIO, you've got some of the other local manufacturers that really being able to stand in the gap. Now, over the 1 year spectrum here, we were just taking a look at the share price, and it's still down 27% over that time period. So still some ground to be made up right now.
Yeah, and just for some context here, out of the car makers that reported, Li Auto, the only one that actually reported lower delivery.
Interesting.
Down about 11%,
Yeah.
XPeng up 4%, BYD saying they were up about 3.6%. So the growth rate is slowing,
Yeah.
but it's still pushing higher. That probably speaks to just how much more developed the EV market is there.
Absolutely. We've got one more big ticker to bring your way here, and a broader theme that we're discussing on the other side of this short break. We've got all your markets action ahead. Stay tuned. You're watching Yahoo Finance.
Apple will be reporting its latest results after the bell this afternoon. AI investments are really going to be front and center of what investors will be looking out for. The Financial Times reporting this week that Apple has poached dozens of AI employees from Google, and it's building a lab in Zurich to further develop their AI technology. Specifically, Brad, the FT saying Apple's poached 36 AI specialists from Google as well. I will point out, a lot of analysts have talked about where is Apple going on AI, Gen AI specifically. They haven't necessarily put out all the plans, although Tim Cook has talked about development in-house. Reality is Apple is always late to the game on the latest technology, but they do study the market and in many ways bring out a product that is a lot more, what's the word, for mass scale?
like
Mass
that.
appeal.
Yeah.
I mean, I was thinking about this today. You talk about the tablet, the watch, mixed reality headset, all those, they were late to the game.
Right, and it's all got to figure out for Apple what type of workforce they need to be able to continue to not only put the dollar investments out there, but the human capital resources around those investments too. I was looking at actually a very interesting study from Deloitte talking about the state of generative AI, and in this Q2 report, they said that we're the first inning of a 1,000-inning game, and there's so much to be figured out with regard to the generative AI
How
space.
do the innings break up? That's my question.
Yeah, that's a good. Yeah, who's on offense, who's on defense, who's batting, who's in the field. But
Yeah.
as of right now, that's the type of scenario that we find ourselves in very early on right now.
And just to throw out a few numbers here, Microsoft saying they're spending $14 billion a quarter. You had Google saying that $12 billion in the first quarter. So, I mean, we're talking billions and billions. Whether Apple gives a number today in terms of investments, we'll be watching.
Absolutely. Coming up in the next hour, Madison Mills and Brian Sazi take our place for a new show, Catalyst. They're going to be diving deeper into what's moving the markets here, plus the Fed decision finally out. We're thinking about it. We're talking about it. Will investors now turn to earnings to drive market momentum? Plus, our very own Julie Hyman sits down with the CFO of Qualcomm to discuss the latest results from the company and the state of the chip industry. You do not want to miss that. Stay tuned. You're watching Yahoo Finance.
It's 10 a.m. here in New York City. I'm Madison Mills alongside the Brian Sozzi, filling in for Shauna Smith this morning. Welcome to our brand new show, Catalyst.
All right, from equities to commodities, we're decoding trends and uncovering the drivers behind today's market moves.
Our team of experts here to help you navigate all possible outcomes so you can make the best decisions for your portfolio.
It's Thursday, May 2nd. Let's dive into the catalysts moving the markets today. The Fed calming investor fears that sticky inflation could mean rate hikes. Fed Chair Jay Powell once again saying cuts are on the horizon, but the timing is unclear as progress to that 2% inflation target remains quite bumpy.
And Apple's China problem expected to come to light in its earnings release coming up after the market close. Investors looking to see if the tech giant can maintain the momentum that we've seen from the previous Mag 7 members that already reported, and whether AI is going to help or hurt them this quarter.
All right, weakness in consumer brands showing cracks in consumer spending. From Starbucks and McDonald's to DoorDash and Shake Shack, inflation is weighing on those lower income consumers.
Let's begin with today's top story. Apple earnings expected after the closing bell. The street bracing for a potentially disastrous quarter from the tech giant after reports indicating that weakness in China is going to weigh on iPhone sales. Here's what experts are telling Yahoo Finance about what investors should be listening for.
That's the problem with Apple. It's not a China issue, it's a competition issue.
Between the iPhone sales, between the geopolitical issues in China, which is still a very big market for them, and now they're having to do a little bit more of what the Chinese government is requesting. You know, the car project was canceled, which I think in the long run was the right thing to do, but, you know, it could have been interesting earlier if they kind of figured out a different path. You know, and of course, then Gen AI. What are they doing with Gen AI? That's what everybody wants to know.
And China, as we just heard, one of the biggest hurdles for Apple right now. Counterpoint Research reported that iPhone sales dropped over 19% in China over the last 3 months. This is competitor Huawei launching its latest device, and Qualcomm reporting that 40% growth in sales to Chinese smartphone manufacturers in their earnings. That could be an indication, Saz, that we've got a rebound in the Chinese market. But what does it mean for Apple? It's probably not going to be a benefit to them.
Well, you were all over this China angle, and look, I get it. It's the second largest, most important market for Apple, of course, behind the United States, and it's long been seen really as a growth vehicle for Apple's stock price. But I would counter that I think investors know this. I mean, Apple shares, they're in the absolute tubes this year. How often do you see Apple shares down double digits only a couple months in the year? It's not the norm. For me, I'm starting to look for some other catalysts, start to think about what might be happening in a couple months. I have the Berkshire Hathaway annual meeting coming up on Saturday. That could be a potential catalyst for Apple. And I also have this earnings report, and I'm very curious if Apple follows its usual playbook and comes out with a big new buyback plan. Last year at this time, Apple came out with a new $90 billion stock buyback plan. There's been some whispers on the street. Maybe they dump something like that on the heads of investors tomorrow, or tonight, I should say.
It's a really good point because we always wonder what are they going to do with all that cash they have on hand.
They're not giving it to me. I'm giving them my cash, Madison.
But if they did give it to you, wouldn't you be happy and wouldn't the rest of the street?
Go buy some Apple stock with it.
Real quick other point on China as well. Elon Musk snubbing India over the past week when he went to China. I wonder if we're going to see any sign that Apple could be going to India to make up for some of that market share. You're laughing at me.
No, I was just wondering if Elon uses a Huawei phone or a Samsung. I mean, Elon, I know you're watching.
I think he'll do whatever Xi Jinping wants him to do.
Hit me up on my iPhone, right?
To be honest.
Oh, wow. Ooh, mic drop there. All right.
Too much.
Earnings are once again top of mind for investors now that the Fed decision is over. Fed Chair Jay Powell offering little guidance on the path for future rate cuts, but calming fears that sticky inflation could lead to a rate hike. Investors return to watching relatively good earnings season, with sales and profits mostly beating Wall Street estimates. So are earnings enough to revive this bull market? Joining us now is a friend of the show, Deepak Puri, Deutsche Bank CIO of the Americas. Deepak, good to see you. As always, we're going to drill down to earnings, but was it just crazy talk in your mind that we were even thinking about a rate hike at any point this year?
Indeed, but I think when you look at how the year started, Brian, I think you can easily argue that rate hike was completely off kilters, right? There's no way
we're looking for 6 cuts.
Exactly, right? 265 odd basis points of rate cuts. But then as the quarter progressed, you started getting these misses on inflation, right? Both on nominal and core. You start feeling, okay, the geopolitical risk, it's an election year, price of gasoline is going to play an important role. You know, all that can manifest itself to a inflation backdrop that can be a little bit discerning. And if the Fed is truly data dependent, then for how long does the Fed push back on this narrative that at some point you need to increase rates. So I think yesterday, Fed Chair Powell really took that out of equation, said, we are not even thinking about rate hikes for at least as of today. And then that gave the markets a little bit of a sign of relief,
But how long is that sigh of relief going to last, particularly if you believe what Chair Powell is saying about the long and variable lags? Does that eventually weigh on growth in the latter half of this year, or are we just seeing the market getting in line with the Fed finally?
I think the markets were mostly in line in late March. If you remember, the March meeting, the summary of economic projections had 3 rate cuts, and the market was looking at 3 rate cuts. As of today, there's a 1 in 3 odds that the market may not see any rate cut for the rest of this year. And
is that too much, by the way?
It could be, because our base case is that we're still going to see 1 to 2 rate cuts this year, and another one, early next year. And I think the rate cuts, it's really the timing that's been pushed back. Now you're looking at probably June, July out. September, most likely the first month where rate cuts would come into picture. And then most likely post-election. You have 2 Fed meetings post-elections, and those could be the live meetings for rate cuts. And that's what market needs to factor now in. We've been used to. And I want to also mention that just because there's an elongated pause does not mean it's negative for risk. It's just like we're used to seeing 6 months from the last rate hike to the first rate cut. This time it might be a 12 to 14 month exercise.
Has something shocked you this earnings season?
Nothing really. I mean, actually, I like the fact that it's been broadening out. You see a lot of financials, industrials, energy. All these companies are starting to pay some cash back to the investors, which is a good news. I think
who doesn't like a dividend check, right?
Indeed. So I mean, that's good and bad in a way, because maybe there's not enough, positive growth momentum there. Nothing really comes to mind, to be honest. I think the big tech earnings for the time being has been really solid. They have mixed results, but in general, I would say much more positive than what the street was expecting. And the fact that, they're still capturing market share, the revenues are growing, that's all very positive. The AI secular tailwind is here to stay.
One sentence takeaway for Apple earnings?
Well, I cannot talk about individual names. I would say you should continue, your earlier discussion right there. I think Magnificent 7 might be Magnificent 4 by the end of the year.
All right, that's a headline for us, Deepak. Thank you so much. Really appreciate it.
Thank you
for
so
that.
much.
That was Deepak Puri of Deutsche Bank here. Now turning to the state of the consumer, we see the through line of the weakening consumer continuing from Starbucks to Yum Brands and now DoorDash and Shake Shack. DoorDash seeing growth decelerating as declining volumes and higher labor costs weighing on its outlook. We also have Shake Shack missing estimates for same store growth. You're seeing both of those names in the red this morning. Really tough saws for DoorDash, down almost 14%.
Yeah, investors really getting delivered some losses from DoorDash. You got that, right? Come on, you're feeling those big Thursday vibes, Madison.
Turn the mics off.
All right, well, here's the real deal on DoorDash. Let me start there, because I think the JP Morgan team really did a nice job in their note this morning breaking down the quarter. Tied it all in a bow, it's that there is concern that growth is going to slow down in the second half of the year. Now, if you go back, right on the top of that DoorDash earnings report, you can see the average order value slow down sequentially every single quarter. And now there's concern as DoorDash goes up against some tough comparisons versus last year. Growth slows, maybe they miss a quarter. All of this coming at a time where the company's investing aggressively. Put all that together, I can understand the pullback. Shake Shack, I really don't understand. Pretty good quarter from that company.
It really wasn't that bad, but I do quickly want to say that DoorDash did something unusual in their earnings. They really pointed to policy about earnings, and I don't mean earnings like our earnings season. I mean earnings for employees, the wage gains that we're seeing in Seattle and here in New York City due to some of the policy changes. I wonder whether or not that is really a headwind for them. Is it that big of a deal? It's basically a $150 million bump to them. Is that big of a deal to their balance sheet?
It's going to be a big deal for us, because we've heard from all these restaurant companies. We heard it from McDonald's on its earnings call this week, how notably in California, after those wages went up significantly, McDonald's starting to pass along higher prices. Suddenly now, maybe it costs $10 to deliver me a Chipotle burrito from a DoorDash. These are things you have to be concerned about. We, as consumers, should be concerned about it, because that's a catalyst for more money coming out of my wallet, Madison.
It is, and it's also an indication to me that if you are spending so much money getting food, are you going to spend on coffee? Another piece of bad news for Starbucks.
Very true. All right, coming up, Qualcomm shares getting a boost after better than expected quarterly results and some AI hype. We'll speak to the CFO on the other side of the break.
We're going to do a quick markets check sponsored by Tasty Trade here. Taking a look at the markets, we are seeing green across your screen, though the S&P 500 relatively unchanged here. The Nasdaq up 0.3% coming off its lows following less than hawkish anticipated commentary from Fed Chair Jay Powell. Now all eyes on those Apple earnings coming out later today. Having said that, we are seeing a little bit of weakness in the tech space, particularly in the chip sector here. So interesting to see that that is continuing to weigh on markets after those Qualcomm earnings, which I know we're going to continue to talk about here.
Yeah, I'm jacked up about those Apple earnings. Bring them on out. All right, earnings out of semiconductor giants have been all over the map. AMD shares falling on the back of results that failed to impress AI-minded investors. Intel's earnings left much to be desired, and its stock was absolutely obliterated. But it was a different story for Qualcomm, which signaled recovering demand for its handsets with upbeat forecasts for sales and profits in the current quarter. Yahoo Finance market domination anchor Julie Hyman joins us for a deeper dive into how semis have performed so far this year. Julie, great to see you in the morning.
Oh, good to see you too, Sah. So I think one of the takeaways here is that semis are not a monolith, right? Last year was a different story. We saw the rising tide lifting all boats. This year, we have not seen that situation, particularly as we've started to get the earnings reports. So let's run through what we have seen so far. Qualcomm, as we mentioned today, is up about 9%. It's up about 24% year to date here. So obviously impressive performance from the likes of Qualcomm. It's a more mixed picture in today's session, as you see from the heat map of the semiconductors. And if you look at the year to date chart for the semis as well, and let's equal weight it just to give a better look, you've seen a number of the stocks that have actually fallen. Intel has been the worst performer among the semiconductors, and then it's been sort of a more mixed picture overall. Let's take a look at the SOX, the Philadelphia Semiconductor Index here, as we have seen it rise year to date. The peak in March here, and since then we've seen a pullback of more than 10%. Contrast that, if we can look at a 2-year chart of what we've seen from the SOX. I mean, basically here you had NVIDIA coming out with those blockbuster numbers demonstrating the demand for AI, and it just took off. Everything took off. All of the members of the SMH, which is an ETF that tracks semiconductors, were higher last year. All 25 members rose on the year, helped in part by all of that optimism for AI. But this year, as I point out, you've seen that kind of waning, and you have seen more dispersion within the semiconductor space. And that's because their end markets are different, right? Whereas NVIDIA is selling a lot of chips to data centers to power AI, AMD is not yet competing on the same level. It also disappointed in the gaming space. So remember, there's stuff other than AI that is the end markets for these companies. Take Qualcomm as another example. It benefited last quarter largely because of perhaps a trough in demand for smartphones. So you have to remember where these companies are selling chips to and for what purpose. Let's dig a little bit more into Qualcomm specifically now, though, because those shares, as I mentioned, are climbing higher today after giving an upbeat outlook for sales and profit in the current quarter, and also signaling a rebound in that smartphone segment, particularly in China. The chipmaker's phone sales in that country surging 40% in the first half of the year. Akash Palkhiwala, Qualcomm CFO and COO, is joining me right now. Akash, it's great to see you. Thanks for being here.
Great to be here. Thanks for having me.
So I want to jump right into smartphones. That is still your biggest line of business here, that 40% increase in the first half of the year from chips there in China, definitely catching some attention. Chips overall for smartphones for you guys, though, still not seeing a huge recovery. When are we going to see that recovery, and what is it going to look like? What's the magnitude going to be?
Yeah, I think we're very happy with what's happening in the smartphone market for us. If you look at the Android market, we've seen this tremendous mix shift towards more premium devices, which is a great trend for us. We are very strong at the top end of the market, where we make chips that lead on performance across the board, on processing, on connectivity, and on AI. And so we're seeing the benefit of that show up in our numbers, and we're very happy about that. As we also look forward, we're seeing the initial steps of having Gen AI happening on devices. We've talked a lot about Gen AI in cloud, but our vision is that eventually, just like processing happens on cloud and devices, Gen AI is also going to happen on cloud and devices. And so we're seeing the first steps of that happen in phones. We're going to start seeing that happen in PCs, in automotive, in IoT. So it's a very broad trend for us, and we're happy to see that take off in our favor.
How eventually, Akash? I think that's what a lot of people are trying to get their arms around. And I don't know if you heard what I was talking about earlier with some of the other semiconductor makers. We're seeing this kind of uneven end market demand and AI integration. So when it comes to smartphones, when are we really going to start to see a tipping point, if you will, where there is going to be more AI functionality on the device itself?
So I think in terms of integration within hardware, we've seen a lot of that come through already. We're going to announce a new chip later this year, Snapdragon 8 Gen 4, that will add a lot more capabilities versus what we have in the last generation. And so we're excited about that. But the use cases, you saw phones launch earlier in the year with a certain number of use cases come through. And I think Samsung talked about the success and the adoption of those features on their devices in their earnings a couple weeks ago. I think you're going to see that happen across the board later this year in premium devices. And then next year, you'll see the same trend happen in mid and low tier devices as well. So we're at the front end of, I'd say, a multi-year trend, and we're excited about what the devices can do with this capability. And there is an upside opportunity for us if this drives an upgrade cycle in smartphones.
Akash, I want to dig a little bit more as well into different types of smartphones and where we are seeing demand and not seeing demand. It seems like, reading through from your results, that a lot of the demand, the China demand, for example, is coming from Android-powered devices. What can we extrapolate there versus iOS-powered devices?
Well, I think generally the trend is that there's more demand for devices at the premium tier, and the mix of devices across tiers is moving up, and that's, as I said earlier, in our favor, and that's a trend that holds across the market. The second trend, as I said, is Gen AI being adopted into the devices. And really, it's not just about smartphones, right? When we talk about Gen AI adoption and this AI Hub product that we've come out with, which allows people who are making devices and applications quickly adopt on-device AI on our chips. That's something that extends to PCs, and we have a new set of PC chips coming out shortly and new devices coming out shortly. It will extend to our automotive products and then also to our IoT products. So it's a broad trend for us, and as Cristiano outlined on the call, our priority is to focus on diversification and growth. And the place we are at in terms of our technology portfolio allows us to do that.
And where are you in terms of that diversification journey, right? I mean, it's interesting that we're having this conversation now because I know you guys have been building up your auto business, and it did well in the quarter. IoT, Internet of Things, did less well. But it's really the smartphone business that surprised on the upside, and that's the business that you're trying to get less reliant on, right?
Well, I think the general strategy of the company has been to take the technology that we've created for smartphones and apply it to all other edge devices, right? And if you look at our automotive numbers, what we announced this quarter is the design win pipeline is now up to 45 billion. This was approximately 18 months ago, it was 30 billion, and that's a very, very significant increase. And within that, a third of the design win pipeline is being driven by ADAS, which is obviously a very important market going forward. And we've become one of the key technology suppliers on ADAS. So we're excited about that. Julie, if I also step back and give you kind of a report card on how we've done on diversification. We started with RF front end a few years ago, and we've become one of the leaders there. Automotive, now we've become one of the leaders. As we look forward, we have this opportunity in AI PCs as the transition in the PC happens to devices that people are going to interact with differently, and it's going to be AI first. We think there's a tremendous opportunity for us. And then we're also seeing the same trend happen in industrial devices. What used to be microcontroller-based devices is moving to microprocessors. It's moving to AI, and that plays to our strengths. So we're excited about that as well.
Akash, just a sort of very big picture, zoomed out question here. A year from now, what percentage of the chips you're selling will have some sort of AI capability versus now?
I'd say pretty much every chip that we make going forward is going to have a significant amount of on-device AI capability. And if you think about on-device AI, it has tremendous advantages. First of all, It allows you to do things that you can't do in the cloud that are more specific to the user while maintaining security and privacy. The latency of those applications is very fast because it is happening on the device. You don't need to go to the cloud. From a cost perspective, it's in some ways it's free because once you purchase the device, you're using the capability that's dormant in the device to do AI versus going back to the cloud. And we understand how expensive it is to do some of these use cases in the cloud for app developers. So we're excited about what on-device Gen AI means across all these devices.
Akash, interesting stuff. Great to see you. Thank you so much.
Great to be here. Thank you very much.
Maddie?
Julie, that was great. Thank you so much for bringing us that conversation. And I loved what you asked about a year from now, what percentage of chips are going to have
Real pro right here.
All was the answer. So
Basically, yeah. Everyone.
really great interview. Thank you so much for that. It's time for some trending tickers here. Shares of Etsy falling over 16.5% after its gross merchandise sales declined more than 3% in the last quarter, citing a more challenging environment for its consumer discretionary products. CEO Josh Silverman saying signs of weak consumers could be a headwind for Etsy's marketplace growth. It's so interesting to me, Sazi, the companies that are citing this versus the companies that came out previously and said, actually, we're seeing no consumer weakness at all. So I have to wonder whether or not the ones that are struggling are ones that are just having idiosyncratic issues, or if we are really seeing cracks in the consumer right now.
Yeah, it's more like oopsie today instead of Etsy. I mean, it's just really not a good quarter. But I think the Evercore team really summed it up super nice. That this is a company remaining or just continuing to be very reliant on discretionary shoppers. Now, what did we hear from Starbucks yesterday? Besides the fact that their quarter was an absolute disaster, that occasional shopper, that customer that is maybe not having the same amount of money in their pockets for whatever reason, inflation, you name it, they're not buying at the same rate they were a couple months ago or last year. So by extension, that is going to hurt Etsy. Secondarily, I appreciate Etsy's platform. I've bought stuff from there. Josh Silverman, one of the best CEOs in the game. But even still, you can't discount what the likes of a Walmart, Target, Costco have done to improve their website experiences, same-day delivery, you name it. Costco's selling a lot of gold bars. Those companies are the online winners in this type of environment. Etsy is not.
It's a great point, Sazi, and I think it's really interesting, particularly when you look at the fact that eBay also struggling with something Etsy noted as well, which is the habitual buyer. They
eBay's
noted
still around?
eBay is still, I'm buying on eBay, which I'm going to talk about in Wealth earlier. You guys need to stick around for another hour because you need to be using dupe.com.
What? I don't even know what that is.
But, I'll show you. You with your Tom Ford perfume, you're not using dupe.com. Having said that, eBay here, okay? Purchases within a 12-month period, their habitual buyers down 1%. That's a lot. That's 132 million people not buying year over year.
Okay, so that's a lot of people.
So that's a lot of people. Okay, another stock we're watching, moving on here today, is Wayfair, the online furniture retailer beating the street's revenue expectations, narrowing its Q1 losses here. This release marking the company's 6th consecutive quarter of share gains. And Sazi, this to me does indicate a consumer that is holding on to their house for longer, given that we've got, why are you shrugging at me?
I have to separate my views from a consumer standpoint on Wayfair. I love this site. It just works. They have great furniture. They're better than IKEA. The customer service is great. If something shows up in a box broken.
Why are they better than IKEA?
IKEA,
customer service?
Quality, customer service. If I get something from Wayfair, like I have, the box will show up broken. They don't even want me to ship it back. They're like, you keep that piece of junk. We're just going to send you something new. I can appreciate that. From a pure number standpoint, I don't get this market reaction. You look at their average order value, that was down a little bit year over year. Free cash flow negative, almost $200 million. Active customers flat, year over year. So it wasn't a blowout quarter by any stretch of imagination. Maybe this is just a lot of short covering.
A lot of short covering potentially, but also the CEO saying that they are on an upswing. So this could be an indication that this is more growth to come for the company, and perhaps that's why we're seeing some more upside today.
All right, let's stay on somewhat of a turnaround story thing. The Carvana bears just got run over by the company's earnings report. Carvana said it sold 16% more used vehicles than a year ago. Not bad, considering relatively high interest rates. The company was also profitable. Yahoo Finance's senior autos reporter, Praz Subramanian, has all the deets. Praz.
Yeah, Brian, this is, eye-popping what's going on here with Carvana, right? This is a turnaround story that I've never seen before, right? So like you mentioned, big revenue beat, up 17%. Net income, they made money, $49 million. I'm shocked by this.
A lot of
record adjusted EBITDA, right? But the big thing also, gross profit per unit, of $6,400 per unit, up from $5,300 a year ago. So what's going on here? I'm like, are they just not reconditioning the vehicles? Like, what's the story? I am actually kind of shocked. The father and son team, the Garcias, I got to hear what they're doing. But I mean, look at the stock price now.
It's insane.
Yeah,
this was our worst company of the year a couple of years ago. but they earned that. I mean, it hasn't been an easy road for Carvana at all.
Hate to say it's a buy signal.
The Yahoo Finance saws Pros buy signal.
I'm not writing that.
I mean,
look.
You can write that one up. We are definitely. Look, I'm completely shocked by this, but I gotta hand it to them. I mean, they even said they're going to be able to pay their debt.
This could be another trade down opportunity. I mean, Carvana. You go into their website and you've seen prices for a lot of cars. You follow this industry, Pros. These car prices have come down a lot, especially used vehicles. So people might be going to Carvana to save a couple extra bucks instead of buying something new at a dealership.
Yeah, they're also kind of going. I've noticed, Saz. I mean, anecdotally, they're going with more cheaper vehicles. I think they're hitting that niche with people that want cheaper vehicles and they can't find them elsewhere. They can say, hey, we'll buy them across the country at give you a discount. There's no warehousing.
I got my Corvette. It was great. They came over and delivered this thing to my one bedroom.
Well, that's back in the day but they're selling really nice cars. Now I think it's more hitting that market of people that need vehicles.
We got to get him ready.
Guys, this is important. Okay, the stock is up over 140% year to date.
Yeah.
That's crazy.
Worst company of the year.
Short it now, you guys. All right, thank you, Pros. Really appreciate you as always. That was really fun.
The best company list here.
Thanks for joining us. And
poor Maddie.
Rebound of the worst company of the year. Hey,
I should just stay at my desk.
Well, Pros lets me sit at his desk every morning, so I owe you some laughs on set here. It's just some inside baseball for our listeners. Yeah. We're hot desking. All right, more markets action coming here ahead. Stay tuned for more. You're watching Yahoo Finance.
fate of Paramount hangs in the balance as media house Skydance does battle with the tag team of Apollo and Sony. That battle led to the ousting of longtime CEO Bob Bakish this week and more unease among shareholders. Joining us is Ariel Investments founder, chairman, co-CEO, and chief investment officer John Rogers. We should note John is a Paramount shareholder. John, thank you for coming on Yahoo Finance as always. We'd love to get your thoughts about, as a shareholder from Paramount, your thoughts on what's been going on this week.
It's pretty extraordinary. I've never seen anything like it in the 41-year history of Ariel. You know, it's just really crazy to have the CEO fired in the midst of earnings season, in the midst of an M&A transaction, in the midst of a really crucial negotiation with Charter Communications. It just doesn't add up. It just really doesn't make sense.
How big of a mistake was the Bakish ousting, in your view?
I think it was a mistake. You know, the last couple of quarters, Paramount has been on the rebound. You know, they've been doing better than expected. Going to be profitable next year in the direct-to-consumer area in North America. And Paramount Plus is doing really, really well. You know, their core franchises, whether it's Super Bowl or Grammys, have been doing great. You know, Top Gun, Mission Impossible. You know, things have been on track to get better these last couple of quarters. So it's just not one of these companies where it's starting to deteriorate again and you don't see the sun coming out in the future. In this case, it really feels really good about where Paramount's position. It's only selling at 7.5 times next year's earnings. It's a cheap stock with a really, we think, a very positive future. So it doesn't make sense to let the CEO go, we think, in the midst of this recovery.
John, I should mention, of course, too, Apollo is the parent company of Yahoo Finance. Would you support, you know, the Skydance deal? And then, what do you feel in terms of just being a shareholder of this company, potentially not getting the best possible price for your investment? By all indications, Apollo is willing to offer a significant premium.
Well, as we've talked to board members and talked to management, they've always promised us they were going to treat all shareholders fairly. So if what we've read is true, that we're getting diluted in this transaction, that's not a good feeling, and it's something we don't think is fair, and we don't think it's proper. We really do believe that Apollo, from what we've read again, has a much stronger deal. Apollo has plenty of cash, a potentially great partner with Sony. It just makes much more sense to have those kind of experienced hands take over this company, pay out all of us A and B shareholders, get cash for our shares. It makes all the sense. Skydance is an up-and-coming company. It's smaller. You know, it's something we don't know whether it can work, but the price they're willing to pay and the valuations that we see, it's just a significant discount from the value we would get from Apollo.
Who do you like as a new CEO?
Well, I think the idea that they have 3 CEOs here on an interim basis is something that also is unprecedented. There are a lot of good people out there who could help, but I think that's one of the great things about the Apollo-Sony deal, is Sony brings terrific management, terrific experience. They've been able to really utilize their content. There will be great synergies also because Sony has their studio, Paramount has their studio, and the lot that's there that's world famous and historic. Right. So the amount of being able to come together just makes a lot of sense.
John, can I try and get you to give me a name here? Do you like Ellison?
Oh, I don't know Ellison. He seems like a young, dynamic person, but. Again, the Sony management just gives us a lot of comfort. And the Apollo leadership, we know a lot of the senior people at Apollo. They're absolutely terrific, world-class investors. They'll be able to put the right team together. It's not for us to tell them exactly who that person is at this moment.
John, I know you're a longtime Warren Buffett follower. You're a noted value investor. How hard is it to find great value in this current market when there's just so much attention to every piece of economic data and what it may mean or may not mean to the Federal Reserve?
Well, I'm on my way to Omaha today, as I always do. I love going to the Berkshire meeting and, always learn from Charlie Munger and Warren Buffett. It's going to be sad to be there without Charlie. But right now, there are a lot of bargains in the small cap value space. Everyone's loved the large cap growth stocks, the Magnificent Seven, and whatever that's morphed into. But that's the sexy place to be. AI is the place to be. And these stocks seem really neglected, misunderstood, not well followed by Wall Street. And it reminds us of what it was like at the end of the century when the internet bubble was really booming, right about to bubble, right about to burst. Small value did extremely well as that reversed. And so we think it's going to be a great time to find bargains and great opportunities as a value investor in today's market. And ultimately think that the lower rates over time will help, because sometimes smaller companies have a little more debt, a little more risk to them. A more benign rate environment should be helpful for small cap value.
Well, speaking of the Berkshire Hathaway annual meeting kicking off this week, investors are eager to hear Warren Buffett's take, of course. We all are. As a longtime attendee, like you mentioned, what are you looking to hear specifically from Buffett this weekend?
Well, I think what I'm looking for is, one, I hope he'll talk about Paramount. You know, Berkshire's been a longtime shareholder, along with other good friends like Mario Gabelli and people who we think are thoughtful investors. So we would really like to get his perspective on Paramount specifically and the future of the media space and what's happening there. I'm also curious about his thoughts on the regulatory environment, because right now, you know, when you look at some of the potential transactions that are happening out in the markets, people have been concerned about the FTC and the Department of Justice sometimes slowing down some types of M&A. So we're curious to see if he has some perspectives and points of view on the current regulatory environment we have and how it's going to evolve going forward.
Well, as you mentioned, Buffett cutting his position in Paramount. Given that, why are you still confident in Paramount?
Well, as last we've heard, he was still a shareholder. But for us, it's just we think that Paramount has so many great assets. They've got the movie studio. They've got CBS and all of the history there. They have the rights, you know, NFL football and the NCAA tournament and the Grammys. And again, great library with The Godfather to Mission Impossible. It's an extraordinary set of assets and newer assets like Pluto, things like assets like BET and Showtime that maybe should have been sold earlier, and we didn't get the advantage for that. But those are still valuable assets that are out there. And it's actually a very strong global company. And a lot of times the street doesn't seem to recognize the plethora of assets that are a part of Paramount.
John Rogers, Ariel Investments co-CEO. Always good to see you. Safe travels to Berkshire, and indeed, enjoy that event.
Thank you.
All right, Moderna shares rallying today after a narrower than expected loss. Yahoo Finance's very own Anjali Kamlani spoke to Stefan Bancel, Moderna CEO, this morning. Anjali.
That's right, Brian. Of course, Moderna doing well considering the lower than expected profit on, or rather losses on the COVID vaccine. That's something that the company has been not alone in trying to fight. Pfizer as well under pressure for the same. But what that means for the outlook of the company is what I talked about with CEO Stefan Bancel. And here's what he had to say about earnings.
So indeed, I'm very pleased with the first quarter. We had our sales above our own plans and above consensus. We even more recently in early Q2 signed Brazil. For the first time, Brazil has a new customer, 12 million doses. And the teams are very busy preparing the Formula 24-25 for COVID for next season. And also the RSV launch, which we are anticipating this spring. On the OPEX side, I'm also very pleased with what we've done. You remember in the fall, we had said that we were restructuring the company to right-size it, especially manufacturing, because of the decrease of demand going from pandemic to endemic. And if you look at our Q1 expenses, including manufacturing, R&D, and sales and marketing, we're actually down $800 million compared to Q1 of 2023.
So really looking at a strong potential year, even on the growth of these COVID vaccines, something that investors are quite tired of hearing about. And it's interesting to see the company entering a new market like Brazil. I asked Stefan about that, about the excitement still surrounding this vaccine. And he talked about really what the COVID market now is. And here's what he had to say.
We're all still learning about this COVID market, the transition. You know, none of us has ever managed a pandemic to endemic transition, because the last pandemic, as you know, was 1918. And so what is interesting in Q1 is that in the US, people kept getting vaccinated. So of course, not like in Q4, but you see a lot of people getting vaccinated, some people getting a booster, especially people at high risk. So that was a pleasant surprise. And then some countries, like, you know, in the Southern Hemisphere, getting ready because, of course, the opposite season. So in Q1, it's their fall. And so they start getting ready in terms of purchasing vaccine and so on. So that's a good news. And again, Brazil is a good example. If you think about Brazil, it's a very big population, of course. We've never ever sold a vaccine during the pandemic in Brazil. And I think as we looked at the data, they were very seduced by the high efficacy that we provide compared to the other mRNA vaccine in terms of reducing hospitalization. And so they went with Moderna.
Now, Moderna is one of those interesting ones. Definitely one of the companies that came out of the woodwork during the pandemic, saw a rise in their stock. It's been down about 8 to 9% in the past year. Investors kind of questioning what the future is. So I asked Stefan what exactly he thinks shareholders are looking for the company in order to ensure ongoing growth. Here's what he had to say.
I would point to two big things: the vaccine platform and the cancer treatment. So if you think about the vaccine platform, we have manufacturing scale. We do not need to build new plants. And if you think about the number of products, it's going to be quite remarkable. RSV, anticipating the launch this spring. If you look at analyst consensus, the RSV market could be around $10 billion market. So it's a big market. It's bigger than the flu market in terms of dollars. And then flu plus COVID. I'm very excited about this product. I don't have the phase 3 data yet. We shared the phase 2 data, which were very encouraging, but we need to wait for the phase 3. But think about if we had the flu plus COVID vaccine, the number of doses for flu is 3 times the COVID market. If you think about revenues, you could add the revenue of flu and revenue of COVID on top of each other for a much bigger opportunity in terms of number of doses. And then you have, CMV, EBV. Those are, easily $2 to $5 billion market. I think you want to think about those markets for novel vaccine, like what Merck has done with HPV, what GSK has done with Shingrix. Those are $5, $6, $7 billion franchises and growing every year. So that's what we have in stock. And that's why we're very excited. And that's going to launch in 24 for RSV, potentially some product in 25, and then 26 and 27. So you're going to see the company growing and growing.
So there you have it, really a strong outlook for the company and moving away from that COVID story with multiple options. We'll just have to wait and see how it all pans out.
We will, but a really great point you got out of him about being able to stack that revenue of flu and COVID over each other. Anjali, thank you so much as always. Thanks for bringing us that interview. We really appreciate that. Well, coming up, outlet giant Tanger posted a strong Q1 report this week. Their CEO joining us to discuss the state of the American consumer after the break. Outlet center giant Tanger released strong earnings this week, reporting a 5.2% increase in same-center net operating income and a 13% increase in core funds from operations per share. That led them to raise their 2024 full-year guidance. The company's been focusing on diversifying the uses of their outlet centers, including more dining experiences. For more, we have with us Stephen Yalof, Tanger CEO. Stephen, thank you so much for coming into the studio.
Thanks
we appreciate
for having
it. I want to start by talking to you about the macro picture that we talk about all the time here. If you got invited by Fed Chair Jay Powell to a Grateful Dead concert and you had the opportunity to talk to him about inflation, what is the single biggest thing that you are seeing that the Fed is missing that you'd want to tell him?
I think the customer is spending, and the customer, the fact that the customer wants to spend money on products, there should be more opportunity for them. There should be more money in the system. I feel like, personally, with rates being where they are, he should come out and spend a day with me at one of my shopping centers. Come to Deer Park and take a look at who's shopping
my home
there,
base.
what they're buying, who's coming in the carloads, the price point, the cars that he sees in the parking lot, because we're getting such a diverse mix of consumers shopping in those shopping centers, driving cars from the entry-level car price points to the highest car price points, because everybody's looking for value. And he needs to understand, from our perspective, who our customer is, what they're shopping for, whether it's that trade-down mentality that people are talking about, or the aspirational mentality of the consumer that's looking to trade up and into better products.
I went to a department store last week. I wanted a tie and a button-down shirt. And the button-downs were now $130, and the ties are about $110. Are the outlets still cheap in the traditional sense? Is that great deal, can that still be found in this inflationary environment?
Well, I think in our environments, the retailer has the opportunity to reprice their merchandise almost daily. So in a full price street retail or other bricks and mortar full price retail, they're holding price, there's a sales cadence. But in the outlet environment, you can mark prices down on a daily basis if you need to, just in order to attract the consumer. And in fact, through our digital initiatives, and we work with a lot of our retailers on this, we can broadcast to their core constituents who shop their stores, any of our accessory stores or any of the family apparel stores, and get out in front of them that, J. Crew's having an extra sale on Wednesday, let's get out and shop. So we're part of that ecosystem of making sure that we get that information out to our customers.
What % of customers are trading down?
Interesting to say. I like to say that our customer is aspirational, and I like when our customer trades up. We don't sell commodity, right? We're not sneakers and sweaters at the cheapest possible price. We're branded value. The difference is, if you're coming to buy sneakers in one of our shopping centers, it's because you want Adidas, you want Nike, you want Puma. So we see a Puma customer who might think that the price points are a little bit out of reach in a full price environment, coming into our environment because it's on sale every day. Similarly, you see those a consumer who maybe does shop in a full price environment, but just wants that brand that they love. And if it's available every day to them, first quality product that comes with that actual brand name. I always go to Ralph Lauren. I spent many years of my career at Ralph Lauren, and the product that hits the outlets is the same product that you might see in the department store, but now on sale. And I think that product never goes out of style. It's heritage product. The consumer loves it, and they're a real important driver of traffic to our centers.
There's still a lot of dumpy malls across America, but those A malls are getting some massive reinvestment. And now where there used to be, let's say, a Macy's at the end of the store is a grocery store. Are grocery stores coming to the outlet, and what does your reinvention look like?
Yeah, so what we're doing in our outlet centers is we're diversifying the mix in order to cater towards more of a local consumer. So for example, the old narrative on outlets was that drive-to consumer that was maybe on a holiday with their family and they stopped at the outlet as one of the, tourist things they did.
Annual rites of passage. Find that great $5
exactly.
Find that deal.
But let's go back to Deer Park for a second, because I know it's a center that you're familiar with. Large permanent population catchment there. That customer sees it more as a regional draw. So if you take a look at some of the out parcels, BJ's being one of them, we have other draws. We monetize that exterior land, that second ring road around our property, and bring in alternative uses, not necessarily outlet uses, but better restaurants, better dining experience, better entertainment uses, Dave & Buster's, better gyms and health clubs, things like that, that draw that customer daily, weekly. And you mentioned grocery stores. You know, we added a grocery store to our shopping center in Hilton Head, South Carolina. And going back to the cars again, you know, it's a high-end grocery. It's a Nantucket meat and fish. Nike was on an out parcel. They went in line in the center. We repurposed that out parcel location with a Nantucket meat and fish, and all of a sudden we're seeing cars coming from as far away as Bluffton, shopping our shopping center, really elevating that whole mix of customer.
How do you make sure the out parcels don't compete?
Well, we're the general merchandise managers of the center. So we're the ones, the out parcels are ours. We get to pick who comes. And you know, it's, as the general merchandise manager, you want to make sure you're bringing complementary uses. And we listen to our customers. You know, our vision statement at Tanger is that we use customer insights and information in order to inform the future of shopping. What does that mean? It means we listen. You know, when a customer raises their hand and says, you know, I want the gym to come back to Deer Park.
Yes, please.
Or I want better food and beverage in your shopping centers. Or I need better amenities because I'm coming with my whole family and I need something for somebody else to do. We listen, we execute, and that's what you see in Tanger.
Okay, you may not be able to say this. I will say this. I'm willing to give up BJ's Wholesales in Deer Park if you bring one of those meat places by me. Like, I'll forget BJ's Wholesale. I'll give up my membership. It's done. It's done. Bring me a meat place. It's great.
My mom wants a Chipotle.
And I'm excited to, if Mr. Powell wants to come and see the Grateful Dead with me, that would be my big pleasure.
Exclusive.
I'll call him after this and let him know. Stephen, thank you so much. We really appreciate you joining us in
Thank you
studio.
for having me.
Appreciate it. Well, let's do a final check of the markets here. Seeing green across your screen today. A little bit more conviction in the S&P 500 off its lows earlier, up 0.3%. You got the Nasdaq up 0.6%. Sauce.
And that is it for us today. Mr. Brad Smith will be taking over the next hour for Wealth, where he will be discussing how consumers should be reacting to yesterday's big Fed speech.
Welcome to Wealth, everyone. I'm Brad Smith, and this is Yahoo Finance's newest guide to building your financial footprint. Our community of experts will give you the tools, the resources, the tips, the tricks that you need to grow your money. On today's show, how fast food companies are navigating inflation and what it means for your wallet. Plus, we're digging into the financial impact to content creators if TikTok is banned. We discuss with an expert. Plus, investing for charity, how giving back can get you closer to some of your wealth goals as well. All that and much more. But first, stock futures this morning, they were in the green, and right now as the markets are currently open, we're watching the major averages hold on to some of those gains as the Fed announced on Wednesday that it's going to keep interest rates unchanged for the time being. Fed Chair Jay Powell reiterating during his press conference yesterday that it will take longer than expected to reach the central bank's 2% inflation target. Powell's higher for longer mantra isn't exactly what consumers want to hear following a fourth straight month of hotter inflation readings. For more on what the Fed's rate decision means for you and your money, we've got Andrew Sliman, who is the Managing Director and Senior Portfolio Manager at Morgan Stanley Investment Management. Great to see you here this morning. Okay, just want to get your reaction to what we heard from Fed Chair Jay Powell yesterday and what this means for individuals out there right now who were expecting, like many of us, multiple rate cuts this year, and it seems like we might only get maybe one, maybe none, as some of the chorus of the no cuts this year continues to grow right now, Andrew.
Sure. Good morning. So, look, I think there's good news and bad news, and I'll start with the bad news. I think the bad news is a lack of rate cuts will hurt investments that are dependent on lower interest rates. It will hurt consumers that have higher levels of debt. Because we won't see debt relief. I think, many ways, this is one of the reasons why small caps have underperformed year to date, because they are more dependent on lower rates. So that's bad news. Now, the good news is what the Fed is really telling you is that they are comfortable that the economy is strong enough that they can be patient on inflation. And the reason why that's important is because if I think about where the market is today and where it could end of the year, the market is going to be priced off of next year's earnings. And if the Fed is saying today, we're good, the economy is strong enough, that leads me to believe that the end of the year, we could be starting with an S&P earnings estimate somewhere around $280, and that makes the stock market relatively attractive today as I think about where it could end the year.
And Andrew, for a lot of people out there who have a very distinct memory of how long we were in the transitory phase and how the Fed was classifying it that way, what's the risk that we remain in the higher for longer for too long type of phase?
Well, that's the risk. The risk is that the Fed hangs in there too long and then the economy weakens. And one of the ways, I think a little trick or not, a way to watch that is really the 2-year yield. Because right now the yield curve is inverted, and that means the 2-year is higher than the 10-year. But if the economy were to start to show signs of weakening, you would see the 2-year yield start to drop. And that hasn't happened yet. And I understand there's inflationary pressures, but that hasn't happened. And typically stocks do fine when the yield curve is inverted, but they begin to weaken when you get that uninversion, because usually that's the 2-year dropping. So to me, it continues to point to the economy is strong enough to handle it, but there's no question, and you're absolutely right, that the risk is that they can overstay their welcome. Look, coming out of first quarter earnings, I'm extremely happy with what we've heard. Not every company was great, but largely overall, I think the quarter was strong and companies were relatively optimistic. So I think there's a good there's a good setup for the stock market to recover after, certainly a weak April.
Is there a portfolio repositioning that investors out there should be considering right now as it pertains to how they're trying to navigate the Fed's time horizon for when that first rate cut could be, and even if it is pushed out to next year, for those longer-term investors anyway, is this going to initiate some type of major pivot in their strategy? Sure.
Well, I think the thing that I find so amazing is the amount of money that's poured into the money market funds. The $6 trillion is sitting in money markets. That's up over $1 trillion over the last 12 months. And on the one hand, you'd say, well, Andrew, that's because, money markets are yielding 5%. And boy, oh boy, 2-3 years ago, it was 0.5%. So certainly it looks more attractive today. But the problem with that comment is people are forgetting that inflation is significantly higher today. And that's what the Fed, the reading, it's not what we all live with. So the tragedy here is that on a nominal basis, 5% looks attractive, but after inflation, money markets are not really more attractive today than they've been in the past. So in other words, investors aren't making great returns in the money market. So I think repositioning, it's that recognition that it's not creating a great return after inflation, will force investors into other assets, not all, some equity, but not all stocks. It will be into bonds and other types of maybe gold, other assets that aren't, really, as I said, the money market inflation kills, money market returns over time. You get better returns in assets that can withstand some inflation. Andrew, thanks so much for taking the time here on the day. Andrew Sliman, who is the Managing Director and Senior Portfolio Manager over at Morgan Stanley Investment Management. Thanks for kicking off the show with us. Well, sticking with the consumer here for a hot second, stubborn inflation forcing Americans to tighten those wallets and pocketbooks, and it's causing quite a whirlwind for online retailers like Etsy and eBay. With consumers pulling back on spending, more companies are worried over signs pointing to a consumer slowdown. For more on this, I'm joined by our very own Madison Mills. I mean, look, I remember shopping on eBay back in the day. That used to be like the inflation hedge, if you will. You find a good deal on some garden gnomes out there and you decide, how could I not buy it now?
You got garden gnomes in the Brooklyn apartment?
I missed out on the garden gnomes that were at the Masters at Augusta a couple of weeks back. So maybe it's just me being upset about that. I don't know. What are we seeing now?
I mean, I get that, because here's the thing. You can get cheaper products on both of these platforms, but the question is whether or not these companies are using their capital to reach consumers and tell them that. And based on these results, they're not necessarily doing that. But it does paint a broader picture about whether or not the American consumer is starting to buckle under the weight of inflation. Results in both Etsy and eBay underlining weakness in consumer discretionary spending. At Etsy, merchandise sales were down 3.7%. Now, an interesting economic indicator with Etsy is what's going on with the sellers, because sellers are increasing their prices because they too are people who are dealing with stubborn inflation. They need to increase prices to be able to withstand their own pricing pressures that they have in their own lives. So Etsy is trying to draw them in with things like Depop, for example, which is part of Etsy, dropping their seller fees to allow for an increase in items listed on the platform. But look at where eBay and Etsy are in terms of the stock price year to date compared to a stock like Amazon that is up over double digits. When you're competing with the Amazons of the world, it's very difficult to maintain market share. And what does that mean for the American consumer? It might mean that they are turning to an easier option like an Amazon, or a cheaper option like a Walmart or a Wayfair, which had incredible earnings this cycle, as opposed to these options that are perhaps a little bit more expensive and a little bit more time intensive as well, because you have to really be searching for these products, Brad.
All right. Interesting reactions that we're seeing here on the day for sure. And especially as we're thinking about what the consumer is doing to really try and look for deals to offset where they're seeing other inflationary pressures right now.
Right.
Maddie, thanks so much.
Thank you, Brad. Thank you. Yeah.
Guys, coming up, a spicy hot quarter for Wingstop. We dive into the latest quarterly report for the quick service wing restaurant. That's coming up next. Let's do a quick check of the market sponsored by Tasty Trade. All major averages are up. The Dow Jones Industrial Average right now up by about 0.6%. S&P 500 holding on to gains of 0.5%. And the Nasdaq Composite, the tech-heavy average, is higher by about 0.9%. Big day as we await earnings from Apple. That comes after the bell. We've got a little bit of time until then. In the meantime, Peloton stock is pedaling quickly today, but not going anywhere fast. The company's CEO, Barry McCarthy, stepping down after just 2 years at the helm. Peloton board members Karen Boone and Chris Bruzzo will serve as interim co-CEOs. The board says the search for McCarthy's replacement is on. The stock rose earlier on a restructuring plan that aimed to cut more than $200 million in expenses, but is now pedaling in reverse. The company reducing its workforce by 15% or 400 employees. This is the 5th round of cuts in just a few years. Peloton is now a $3 stock, and nearly 90% decline from its IPO price, sub $3 as of right now. So how did we get here? Well, the pandemic was a boon to Peloton, heralded as a pandemic darling during the rise in popularity and necessity of at-home fitness. The business quickly scaled up its production to meet demand, albeit marred by supply chain disruptions. Quarterly revenue spiked to over $1 billion, but it hasn't been able to cruise at that altitude. Post-pandemic, with the rise of revenge spending, people going back to fitness experiences indoors and looking to get outdoors and travel even more. This resulted in less demand for at-home fitness equipment. And a fatal event led to one treadmill recall. Then a production flaw prompted yet another tread recall, further hitting the company. The company also suffered a bout of bad publicity. Oh yeah, this one's for you Sex and the City fans out there. In the reboot, the character Mr. Big had a heart attack and died after riding a Peloton bike. The stock fell 11% the day the episode aired, and then 5% the day after. In February of 2022, then CEO John Foley stepped down, replaced by none other than just departed Barry McCarthy. The company would spend the next several quarters adjusting prices of its equipment and membership and gathering partnerships with retailers and even a hotel, all to spur growth, leaving the company where it is now, missing revenue and profit expectations for the third quarter. Now falling short of subscriber estimates and reducing its retail showroom footprint. What was at its height a $50 billion company in market cap is now valued at just over $1 billion. We're going to continue to track shares of PTON, but let's track a simpler ticker symbol out there, WING, W-I-N-G. For the Wingstop fans out there, they reported a solid quarter of same-store sales growth as other quick-service restaurants slumped, citing a slowdown in customer demand. So why are customers willing to shell out the cash for wings here? Here with some insight, we've got Michael Skipworth, Wingstop CEO, and our very own Brooke DePalma. Great to have you here with us, Michael. I mean, look, we were chewing on these, I couldn't resist it. We were chewing on these results here from you guys, and ultimately got to know, what were some of the biggest takeaways from the quarter? What are you seeing in the consumer right now?
Hey, Brad, good morning. Thanks for having me. I think Wingstop's in a very different position than any other brand out there. You mentioned it earlier. A lot of other brands are seeing transaction loss. Customers are going away, not going there as frequently, and it's the opposite at Wingstop. We had a 21.6% same-store sales growth in the first quarter, and that was primarily driven by transactions, new guests, new occasions coming into the brand, and that's on top of 20% growth quarter one a year ago. So 40% growth in 2 years, which is pretty incredible. And I really think it speaks to the fact that we continue to focus on delivering value and quality. That indulgent Wingstop occasion, something that consumers are starting to really appreciate as they see others taking price. We've been very disciplined with our approach to pricing, and it's paying dividends for our brand right now.
Michael, Wingstop did increase its 2024 outlook for sales growth to low double digits here in the U.S. What are you seeing so far in April and Q2 that gives you confidence that this momentum will sustain?
Brooke, I really think it has to do with the fact that the growth strategies that we're executing against have a lot of runway in them. We talked about our growing ad fund. It grew, our system sales grew by 37% in the first quarter. So that's almost 40% more dollars that we can go invest in advertising. We talked about it being on NFL playoffs for the first time. but yet we were only on 2 games, 1 spot in each game on a 4-game weekend. And so there's a ton of runway for us. We have a lot of momentum in the brand, and it gives us confidence as we continue to execute against these strategies that we can continue to bring new guests in and drive outsized results against the industry.
Michael, I want to hear a little bit more about that new guest. In the call, you said that you're seeing gains across all cohorts, all income levels. But with this new guest, they tend to be a bit more higher income. What can you say about that guest, and how does it compare to the traditional Wingstop customer?
Yeah, our traditional Wingstop guest, it does index a little bit more towards that lower income, but we continue to see growth within that cohort. But what we're really excited about, in Q1, we had a record level of new guests coming into the brand. And these new guests, they are a little bit more middle class, a little bit higher income. They index digitally or prefer to engage with brands digitally, and they have a higher average check than our traditional guests. They're less likely to have children at home, think millennial, Gen Z. And the thing we like the most about it is they're coming back to us sooner than our traditional guests, and they're moving up that frequency curve faster, which is pretty exciting for us.
Michael, I wonder, what does menu innovation look like from this juncture for Wingstop? That is the way that you get people into these new orders, whether they be delivery or in-store or on-premise. What does that look like, and what's the roadmap there?
Yeah, the beautiful thing about our brand at Wingstop is we have a very simple model, simple menu. The way we actually innovate is around flavor. We lean into LTO flavors like hot honey rub, which we have right now, that consumers love and enjoy. And then we use the vehicles, whether it's a chicken sandwich, tenders, boneless wings, or classic bone-in wings. And we're able to meet guests wherever they are. We added chicken sandwich just 2 years ago to our menu. That's really been the last menu innovation we've had, and one of the very few over our 30 years. But there's 2.4 billion chicken sandwich occasions served in the U.S. annually, and we think we have a ton of runway to win our fair share.
Michael, you did say hyper-personalization is something that you're leaning into, especially on My Wingstop. How do you think this will increase guest frequency and also increase ticket size?
That's right. Our digital sales for the first quarter were a record 68% of total sales. And that's allowed us to amass a database of over 40 million users strong. And we've invested in this data, enriched the data that allows us to not only inform our marketing strategy, but with the launch of our proprietary tech stack, My Wingstop, we're able to lean into hyper-personalization and really personalize that consumer order journey that we believe will bring guests back sooner, bringing them back more frequently, and drive check as well, which we're pretty excited about.
Michael, businesses are looking for opportunities to improve efficiencies, and one of those areas is in the ordering process, especially in the process of making deliveries and fulfilling orders here. And some are testing out robotics. What does that look like for Wingstop right now?
I think for Wingstop, it really speaks to the simplicity of our model I mentioned earlier. Our average unit volume is about $1.9 million, and you can run a $1.9 million Wingstop with as few as 4 team members in the restaurant. So there's not a lot of labor to take out. 94% of our sales are off-premise, and so it's really a point of distribution. And so fans, where we've invested and where consumers like to engage with our brand is through digital ordering, as I mentioned earlier. So we've invested there to ensure we have a best-in-class digital ordering experience, and we're serving flavor to our guests.
Very quickly, Michael, Rick Ross does own 30 franchise locations. We're here on Wealth. We're always talking about ways to invest your money. How closely do you work with Rick Ross as a franchise operator?
He's a big fan of Wingstop, and we appreciate his support. He's not closely involved necessarily with the operations, as you might expect, but definitely a fan of Wingstop, and we appreciate him and his support.
All right, Rick Ross, the boss, Michael Skipworth, big things coming to Wingstop. Wingstop CEO, thanks so much for joining us here today. Plus, Yahoo Finance's own Brooke DePalma. Appreciate it, Mike.
Thank you.
Thanks. Well, food is in focus today with earnings results from 3 companies. DoorDash, one of them, plummeting after its profit outlook for the current quarter fell well below expectations amid rising costs. The company did see growth in its U.S. restaurant segment decelerate slightly compared to the year prior. Total orders increased at a slower rate than the previous quarter, but the company is seeing strength in its grocery business with a third quarter of triple-digit growth. Turning now to Shake Shack. That's up this morning, up by about 4% after their Q1 earnings beat expectations. System-wide sales saw an increase of over 12% compared to the same quarter last year. The company opened 4 new company-owned locations, including 2 drive-thrus, as part of an effort to increase Shake Shack's presence and accessibility. And let's go to Wendy's here. A quick look at Wendy's, also up this morning. After reporting their earnings results, their digital sales focus has been paying off, now constituting 17% of their global sales, and a major push into the breakfast market saw high single-digit growth year over year. They're also near completion of the global store redesign, with 87% of all stores already completed by the end of Q1. We've got much more wealth for you after the break here. You're watching Yahoo Finance. A new Reuters Ipsos poll reveals 50% of Americans support a TikTok ban, while 32% oppose the ban. Important to note, the poll did not survey people under the age of 18, which is a critical demo for TikTok. ByteDance, the parent company of TikTok, has around 9 months with a possible 90-day extension to sell its stake in TikTok or face a ban of the TikTok app in the U.S. So what could a possible ban mean for the financial health of content creators. Here with more, we've got Amber Vensbox, who is the co-founder and president of LTK. Amber, great to have you here with us. All right, what would this mean? Let's just discuss that question out of the gate. What does this mean for content creators and where they would have to perhaps reallocate some of their time in creation?
Yeah. As creators, we spend a lot of time in the weeds thinking about how we entertain our audiences. And this is really meant for the creator community. We've had to abstract back a little bit and think about the longer term strategy. What we've seen over the years is that these platforms, they do come and go in popularity. It's ultimately all about what your community wants and where you can meet them, retain them, and nurture them. So today, the creator community specifically is thinking about how they diversify their audience. Where is that home base that's the forever home for their community where they can continue to reach them every day? And then they've really started to think about these social platforms, not as social platforms, but as entertainment platforms and places where they can go fishing for new people to join their community that actually lives somewhere else.
Okay, and so as we're thinking about where the algorithm plays a major role in this too, because you think about the experience on one app or one social platform versus the algorithm on another. I mean, that's how the social platforms battle, is based on their algorithm and based on, of course, using that algorithm to drive more time spent, which creators have to think about on the daily, because that's exactly where the production or the style of production that they lean into is monetizable as well here. How massively could this uproot some of the earnings for creators?
Well, I'm so glad that you pointed out the algorithm piece, because really what TikTok's entrance into the market did was actually change the paradigm of media or social media as we thought of it. So being a new entrant, it actually proved out the model of interest-based feeds versus community-based feeds. We know that these social media platforms, or entertainment platforms as I call them, their business model is advertising revenue. How do you grow that revenue? You keep people on your site. So if you have an algorithm that can keep them there longer, and interest-based feeds do that. What we've seen though is TikTok proved it out, and that's been at their core and their DNA since the beginning. But we've now seen Meta across their properties pick up that same sort of paradigm, as well as Alphabet, Google, YouTube. And so now there is less of a differentiation, but as a creator, across what those experiences are like. And so as a creator, the conversation has really been, well, it's now okay actually to put your content across all these places, because you just don't know which algorithm's going to pick it up at this moment.
Amber, we had famed Shark Tank investor Kevin O'Leary on yesterday, and he mentioned that he wants to buy TikTok. Do you think that creators have an ideal owner for TikTok that would make it so that the experience isn't so vastly different for them to be able to continue monetizing their own name, image, likeness, and creative abilities?
Right. I mean, that diversification in the market is really important. And I do hope that TikTok can find a home. I think it's going to be really challenging for a future owner, because candidly, the secret sauce is the algorithm. And the CCP has discussed that that's not for sale. So you're going to have to find somebody who has really a true sophistication in order to build that out. And I think it's a mix of AI and honestly a huge staff of people in the back end kind of making this work, which is probably the secret there at ByteDance. But I think there's a really big challenge ahead, and this needs to be someone who is not new to tech. This needs to be a true savant that can put something that's similar to the user experience, because today consumers, they're looking for entertainment, and the threshold is just that. And when they stop being entertained, or it stops feeling personalized, they can open Netflix, they can open another social media property. And so there's a huge challenge, and it really does come down to the algorithm.
LTK co-founder and president Amber Vensbox, thanks so much for taking the time here with us today. Appreciate it.
Yeah, thank you.
Many of your favorite musical artists and their music will soon be returning to TikTok after top Hollywood label Universal Music Group failed to reach a licensing agreement with TikTok before their last contract expired. That was back in January. Artists like Drake, Billie Eilish, Adele, they've been missing from the platform. But for more, we bring in our own Alexandra Canal. So, Ali, what's the latest development here?
Well, Brad, a very happy day for TikTok users following this months-long dispute. Universal Music Group describing this joint licensing agreement with TikTok as, quote, a new era of strategic collaboration. Now, this all started back in January when Universal accused TikTok of bullying the label into accepting an unfair deal. At the time, UMG had been pressing the social media company on 3 separate issues. 1, appropriate compensation for artists and songwriters. 2, protections from artificial intelligence. And 3, online safety precautions for TikTok users. Now, per this new agreement, both companies said they worked together to enhance new monetization opportunities and increase AI protections, which we know has been a big headache for the music industry. This includes TikTok removing some of those AI-generated songs that you sometimes see on the platform. In a press release, the CEO of TikTok said the platform is, quote, committed to working together to drive value, discovery, and promotion for all of UMG's amazing artists and songwriters and deepen their ability to grow, connect, and engage with the TikTok community. Now, there were some artists who broke this ban early, both officially and unofficially. Taylor Swift, for example, she returned to TikTok prior to the release of her new album, The Tortured Poets Society. But this has been a clear overarching message from UMG. And of course, it all comes as TikTok has been under intense bipartisan scrutiny. We could see the app disappear as early as 2025 following the legislation that President Biden signed into law. That's, of course, if their Chinese parent company ByteDance does not divest their ownership stake. TikTok did file a lawsuit to block this new legislation in response, but all of this pretty much up in the air right now. So I think for users and content creators, this is something that had been missing for them, just being able to play those 60-second clips of those songs. And now we have all of these artists back, which is obviously not only a good thing for users, but also a good thing for these artists.
Yeah, is it clear how much the artists make, how much they benefit from being on TikTok? Is it more about discovery of their music, or is it more kind of monetizing the fact that they're actually on the platform and that they get the plays, the repeat stream or play?
I think it's all of the above. And in this new agreement, when it comes to monetization, they want to leverage TikTok's growing e-commerce platform. So there's a lot of ways that they could work together to help increase both the presence of these artists in terms of the distribution, but also the financial component of things, because we know that's something that artists have been struggling, especially when you think about Spotify and all these other streaming apps. That's been a big push from these music labels. So we'll see where this continues to go. But for now, it seems like they were able to finally come to a new agreement because they had some fiery words for each other back earlier in the year.
Like I tell our wealth viewers all the time, my wealth plan is to become a one-hit wonder one day, and hopefully,
if we could all be Taylor Swift, that'd be great.
I mean, maybe you'll discover my music on TikTok,
yes.
And that's how we get those repeat plays. So I'll let you know when it drops. Ali Canal, thanks so much. Appreciate it.
Thank you.
Coming up, everyone, we explore how donating can actually help your wallet and help someone else in the process. That's right after the break. Investors had a big reaction to disappointing results from semiconductor company AMD, sending other stocks lower. But why all the attention paid to chip companies? Here to break down why chips are so important, our very own Akiko Fujita. Hey, Akiko.
Hey there, Brad. Yeah, well, semiconductors are increasingly a big weight for the S&P 500. It makes up nearly 10% of the index. It's accounted for nearly half of the gains this year, although much of that's come from NVIDIA. The other reason, though, why semiconductors are so important, they are a critical component in nearly everything that we use. So any news, any shortages trickle across industries well beyond semis. Let's take a look at this data here coming through from Semiconductor Industry Alliance, because that points to just the scale of the chip integration. We're talking about chips in communication devices like desktops and smartphones, chips in laptops, chips in cars, and gaming devices. And the U.S. remains a leader in the space when it comes to research and development, chip design, and the equipment that manufactures these semiconductors. It all amounts to roughly 48% of the global market share, with South Korea right there far behind. But take a look at this next chart here. That shows you how things break down when you look at where the chips are manufactured. The concentration of these foundries, these three right here, all in Asia. When it comes to the most advanced chips in the world, we're talking about nearly all of it manufactured in Taiwan by TSMC. And that regional reliance is exactly why we are seeing the Biden administration dole out billions of dollars in subsidies to bring semiconductor manufacturing back home. That built out of fabs is only expected to accelerate as companies look to stockpile advanced chips that are critical to the advancement of generative AI. So, what does this all mean from an investing standpoint? So take a look at some of the biggest names in the space based on global market share. When you break it all down, Intel is at the top with 9%, Samsung close behind at 7.5%. You're looking at Qualcomm at 5.4%, Broadcom at 4.8%. But the key here is where those companies are competing and where the big chunk of the demand is. And NVIDIA right here, 4.5% of the market share, but it's the biggest leader when it comes to advanced chips, GPUs that are driving the AI race. The market cap for the company, as we've noted before, well ahead of any of its competitors at more than $2 trillion. Here's one thing to leave you with, Brad, because this is a space that is moving very quickly, as we've said. A final number, global chip sales came in well over $500 billion last year. It's expected to hit $1 trillion by the end of the decade, at least according to McKinsey. That shows you just the breadth of this chip space. And as you know, we're not talking about just one kind of chip. There is a very, very diverse set here, which is why you're seeing so many companies compete across the board.
Yeah, a lot of data centers being built out to make sure that those chips can be housed both in data centers and in some of our devices as well. Akiko, thanks for breaking this all down in the entire chip landscape. Appreciate it. Well, individuals donated over $319 billion in 2023, according to DonorBox. We all know giving back is a good thing. However, life gets in the way, and sometimes we just forget. But there's a way to automate giving back, and it might be beneficial for your wallet too. Daffy is a financial platform where you can set aside money, and you can do it in crypto or in the market. Watch it grow, then donate it. To break down how giving back can help someone else and your wallet in the process, we've got Adam Nash, who is the Daffy co-founder and CEO, here with us. Adam, thanks so much for joining us here on today's show. And just first and foremost, just break down how this works for us.
Yeah, it's really quite simple. Setting up a donor advised fund is like setting up any other tax advantaged account, like an individual retirement account for your retirement planning or a 529 plan for college savings. You open the account, you can fund it with cash, you can fund it with stock, ETFs, mutual funds, even crypto. That money is invested tax-free. And then any time that you want to give to any charitable organization across the country, you have an app in your pocket, a few taps, and that money can get sent to the organization that you want to support.
Okay, so with that, I mean, it sounds like it's removing a lot of the friction from the investment into the donation process as well. And a lot of people were trying to understand, okay, where does this change the current experience of just going out and selecting the organization and just donating to them outright? What's the major delta there?
Well, look, in the US, about 60 million American households give to charity every year. So a lot of us are doing this. And most of us are doing it the way you just described, Brad, by just when we're asked, we reach in our pocket, write a check, hand over cash, our card. But the problem is when you don't make it a financial goal, you end up with two issues. One, you're not budgeting for it. So you always have this question lingering in the back of your mind, what can I afford to give? And you don't really know the answer to that if you haven't budgeted. The second problem is it's very hard to do it in a tax efficient way. Giving cash might feel good, but from a tax perspective, donating an appreciated asset like a stock, mutual fund, ETF, or like I said before, even crypto, can be a great way to save additional taxes and support the organizations you care about.
Okay, so what is the business model for Daffy? I mean, how do you realize profits on this?
Well, I'm glad you asked, because the business model is one of the reasons that I think most people haven't heard of donor advised funds. I mean, the fact is, unless you have a high-end wealth manager or accountant, you probably have never heard of a donor advised fund. And that's because the existing industry has mostly focused on the wealthy because they charge based on a percentage of assets, a fee. And so they're looking for big accounts. At Daffy, which we named because it's the donor advised fund for you, we decided to turn that business model on its head and borrow a model from other nonprofits, which is a simple membership model. So when you join Daffy and fund your account, it's free up to $100. And then most of our members pay a simple flat fee of $3 a month.
I mean, here we were thinking that you might just be a stand for some Disney characters out there, but instead of being just a big high-profile fan, it actually means something. Donor advised funds for you. Okay, that's what Daffy stands for. What are you noticing in the next generation of people who are giving to funds, who have grown up with the GoFundMes, who have grown up with giving to charitable organizations or even Kickstarters to help fund certain ventures? How is this next generation, and what are some of the trends that you're seeing in this next generation as it relates to funding either ventures or just giving to charitable organizations?
Well, one of the great things that we see from a giving perspective in this next generation is just a passion, a caring, a willingness to prioritize giving, this belief that not everything you earn, not everything you do is just for yourself, that there are other people out there, that there are causes and organizations worth supporting. And so what we're seeing from this younger generation is a much more active interest in making giving a part of their life. This generation is also far more tech savvy. So the ability to use online tools like Daffy, not only to put money aside, but also to run campaigns for organizations that you care about. One of the most popular features with Daffy is that if you have a fund, for any charity, up to 6 of them at a time, you can run a matching campaign dollar for dollar. And whether you're raising $100, $500, $1,000 or more, matching campaigns can be a great way to get more money and more leverage on your own giving. And we're seeing a lot of young people who grew up with the internet loving this feature. There's
a clear business to consumer, B2C standpoint that it seems like Daffy clearly has, but is there a business-to-business opportunity for the company as well? I mean, I think about so many other financial and specifically app-forward financial services that people are tapping into on their devices, where there are also more opportunities for those services that they're identifying within a broader business realm here too. I'm asking this to try and get a sense of some of the corporations that you see Daffy being applicable for as well in the future.
Yeah, it's a great question. Well, we built Daffy for consumers, right? Like for those 60 million American households out there who give to charity every year. And we believe all of those households should open up an account and be putting something aside for charity. But one of the amazing things when we launched this product just a few years ago is we started getting demand for companies to provide this as a service to their employees. Most corporations offer a retirement plan, a tax advantage plan like a 401k. And now if you join a company like OpenAI or Acorns, you're told when you start that they have a 401k and they have a matching program for that. And they have a tax advantage account for giving, Daffy for Work, where you can put money aside and the company will even match the money you put aside for charity. So we think that this product is applicable not just for individuals, but also for companies.
Adam Nash, Daffy, co-founder and CEO. Adam, amazing to hear about this product and look forward to checking back in the future for sure.
Fantastic, Brad. Thanks for having us on.
Certainly. Coming up after the break, Yahoo Finance executive editor is going to sit down with Kellanova chairman, CEO, and president after their latest earnings report. Hear ye from Brian Sazi on the other side of the short break.
Profits out of Kellanova falling a little shy of analyst expectations, but the company is promising better days ahead in the back half of the year. Joining me now is Steve Cahillane, Kellanova Chairman, CEO, and President. Steve, good to see you. It has been a while. Welcome back to Yahoo Finance. We're not too far removed from the big Fed meeting. Of course, lots of talk about inflation. Now, the Fed seems to think inflation is going to slow down from the last year. From the vantage point of one of the biggest food makers in this country, how do you see it?
Hey, Brian, thanks for having me. First, before I answer the question, I just want to address your opening remarks. You said we fell short of profit expectations. Actually, no, we beat consensus EPS by about 15 cents. We beat gross margin, we beat operating profit, so we were substantially ahead of analyst expectations. Sorry, just wanted to, clarify that. In terms of what we see in inflation, right now I think we're at a mark where we hope the low water mark for the consumer, because this time last year the consumer had SNAP benefits in many states still. They had lower gas prices. They had lower costs. And what we're seeing in our results, what you saw is kind of a 5% price, which is really the wraparound of everything that had to happen last year based on the input cost inflation. So as we look at the rest of the year, we're working very, very hard on productivity initiatives and other things so that we don't have to take any more price and in fact can return to promotional activity and merchandising activity. And so we actually see the back half of the year a volume recovery across our sectors based on the consumer having really grown accustomed to these new price points and lapping the worst of the challenges that they face. Still under a lot of pressure, the lower income consumer to be sure, but the back half of the year we show signs of, we should see signs of improvement.
And important, that I should mention again, of course, big beat, stock prices up. That beat very much a rare thing in the world of food earnings the past 2 weeks, so important there to note. I'm glad you mentioned that, Steve. So when consumers come to the supermarkets, what do you see them reaching for in terms of the Kellanova portfolio?
Really across our portfolio, we've seen good strength and good momentum. Right now, Pringles has got a lot of momentum in the marketplace, a lot of quality display execution happening across the segments, showing great demand. We're seeing a lot of fun and demand for our Pop-Tarts. You may have heard Friday, Netflix is launching a Pop-Tarts movie done by none other than Jerry Seinfeld, the comedic genius and cultural icon. We have displays online for Jerry Seinfeld Frat Pops.
Oh, that's just Pop-Tarts. That's like Mattel and the Barbie movie, Steve. I mean, you're just running back.
Only bigger, Brian. Only bigger.
So take me through. Look, we've talked for many, many years. I'm a snacker. I enjoy my snacks. Now, I have noticed that the size of some snacks have come down amidst this past year and a half of inflation. Have you had to make tough choices on the size of your products?
For years, we've always looked at revenue growth management as an opportunity to make sure we're delighting our consumers at the same time we're managing the business effectively. And by that, I mean maintaining, maybe slightly growing our margins. And so we've actually done less downsizing this past year than we would have done 4 or 5 years ago. And as a mechanic, we tend to do very little of it. But if you think about from a consumer standpoint, if the magic price point for a consumer for a snack is, say, $1, and it used to cost us 70 cents to make that product, but now it costs us 90 cents to make that product. Clearly, you can't continue to sell it for $1, so you're left with a choice. Do you raise it to, say, $1.20, or do you make the pack size smaller so you can continue to sell it for $1, but not make only 10% on it? And so I think that's sometimes lost in this conversation about shrinkflation and it's big food is out to rip off their consumers. No, not really, not at all. In fact, it's about making sure you can meet that consumer where they want. Do they want the same size and are willing to pay a little bit more for it because it costs more to make? Or do they want that magic price point and are willing to accept a slightly smaller size? That's really the dynamic that happens, and those are the choices that consumer goods companies like ours face. And we really try and learn from the consumer exactly what they want. And oftentimes we offer both, the same size, but it costs a little more, or a smaller size at that magic price point.
You mentioned choice, and consumers, I think in this environment, many consumers are making choices on what they eat and when they eat it. Are consumers on the low end of the income spectrum at that point, Steve, where they're eating snacks instead of a sandwich for lunch, or replacing or taking 2 granola bars and having that for an evening meal?
No, we don't see that, Brian. We see the snacking occasions maintaining kind of where they were beforehand. So we don't see, a shift from kind of center of plate meals into snacking. We see snacking as incremental to the diet that they maintain. There certainly still continues to be on the go eating occasions. So the breakfast occasion has moved from sometimes the QSR restaurant because it's expensive to a couple of RX bars.
Yeah, especially a Big Mac now is like $9-10 for a meal. It's mind blowing. I've never seen prices like this.
It can be very challenging for the consumer, which is why we start with the consumer and the consumer need state and try and meet that consumer where they are in the best way we possibly can. But we keep affordability as a North Star for our consumers, particularly in an environment where we find ourselves today.
Good day for the Kellanova team. Big earnings beat, positive stock reaction after, of course, that split up that you help lead over at Kellogg. Steve Kaling, Kellanova Chairman, CEO, and President, always good to see you. Brad, let me send it back to you.
All right, thanks so much, Brian, and for bringing that conversation our way. Let's do a final check of the markets here on Wealth. Right now, the Dow, the S&P 500, and the Nasdaq all in positive territory. You're seeing fractional gains across the board. The Nasdaq almost up 1 full %. I'm Brad Smith. Thanks so much for tuning in. We'll see you tomorrow at 11 a.m.